And we start. Or students. How about the last week, the discussion that we had? Do you have any questions? We talk about the national income and basic macroeconomic things, right? We identified the macroeconomic variables, right? Can you remember what are the macro variables? Yes. So that is the way of economics. Macroeconomics identified the economy, right? Based on the set of macro variables. So we identified major macro variables, consumption, investment, savings, money demand, money supply, right? So those actual variables represent the two sectors in the economy, right? Which is very, very important. Can you remember what are those two sectors? That is, we identified as the real sector and the monetary sector, right? So some of those variables represent the real sector, especially the consumption, investment, savings, right? So those variables represent the real sector, right? Mainly the goods market, right? Production, right? And the other one is the monetary sector. We identified the money demand, money supply, right? So then we talk about this macroeconomic uh, policies, right? Economic analysis. Basically, in macroeconomics, two areas focus, right? So when you look at the scope of the macroeconomics, that is basically a kind of economic analysis, right? We talk about this scope. Other one is the policy, economic policies, right? So in macroeconomics, economic analysis means we analyze those major macro variables, right? So how we are going to analyze? Basically, we look at what factors determine those macro variables, especially if you take the consumption, right? So what factors determine the consumption? The theory says that the consumption mainly depends on the income, right? Right. But there are certain other theories also developed when you talk about the consumption, right? So those theories identify some other factors, mostly those factors also related with the income. Maybe the expected income, expected long-term income, permanent income, like that, right? So basically that is most influential factor, income, right? Regardless of if we say generally the income, it may be the nominal income or disposable income, right? Or it may be the future expected income, right? As identify some other theories, right? In consumption. Macroeconomics, you are not talking, there are some theoretical explanations regarding the consumption function, starting from the Keynesian theory. So that explain the absolute income hypothesis, right? And there are some other hypotheses, those are the theories, permanent income hypothesis, life cycle hypothesis, like that way, right? Some other economics explain the consumption and their behavior. So what factors determine the consumption? According to the life cycle hypothesis, Milton Friedman, he and talk about the consumption mainly depends on the lifetime expected income, right? What you earn, you are throughout your lifetime, right? Normally you earn when you are at the labor force, right? When you are working age, you earn, right? Then you come to the retirement age, right? And you are not going to receive the income, right? Since you are out of the labor force, right? At the retirement, after the retirement age. But you maintain certain level of consumption, after the retirement until you death, right? The life cycle, I will just explain that kind of things during different life cycles from starting from your birth to end of your life, how you spend your, how you maintain your consumption pattern, right? So that is basically based on the expected lifetime income, right? So that explains the life cycle, likewise. So there are some other theories that explain the determinants of consumption, right? So likewise, now in macroeconomics, we analyze the basic variables, right? So what determine those variables? What are the factors that determine those variables, and how the variable change, no? And how it move over the time period, trend line and something, no? Right? So that is kind of analysis we are doing, no? Right, in macroeconomics. Apart from that, we need to change these macro variables in appropriate way, no? Therefore, we need policies, no? Right? So those two aspects basically macroeconomics talk about, macroeconomic scope, no? Right? So economic analysis and the policies. So mostly we talk about the policies. Unlike the microeconomics, earlier we did talk about the microeconomics. Now there we did touch the policy part, no, right? There is no such a policy analysis is not there in microeconomics. But when it comes to the macroeconomics, mostly we talk about the policies because we are talking the overall economy under the macroeconomics, no, right? So we need to change or the behavior of these macro variables, we need to change in appropriate manner, no? Right? So therefore, we need policies, no? Right? So the different policies we identify, no? Fiscal, monetary, no? Trade policies, commercial policies, no? Redistributive policy, like that. Those policies are very, very important, right? So that we talk about the last time, right? And then we identified the difference between the policies and shocks, no? Right? Mostly those are similar, no? Right? Why we say policies and shocks are similar? Because basically these policies also affect to the market and thereby macro variables and macro objectives, no, right? And the shocks also same way, but affect to the market, no, right? Okay. Money market or the capital market, no, right? If there's a shock, no, something financial price, no, right? So that is external shock, no, right? Coming from the external environment, right? So that may have effect on the market, different markets, no, right? Sometimes the capital market, stock market, no, right? And then it spread over to the other markets, no, right? Money market, and then finally it affected the real sector as well, no, right? So that is the interaction we see even there also, right? In the monetary sector and the real sector, since these two sectors are interrelated, no, right? Now the shocks also like that way, right? It affect the market and the macro variables, and thereby it affect the macroeconomic objectives, no? That what we are trying to achieve, no, right? So similarities are there. So we talk about these policies, expansionary, contractionary policies, no, right? There are two types of policies, no, right? Expansionary, contractionary, no, right? So, and also the shocks can be internal, external shocks, no, right? Some shocks arise from internal environment, no? If we take the flood, drought, something that's also shock, no, to the economy, no, right? So, and also some kind of external events, no, right? So the crisis, maybe the financial crisis, no, right? Debt crisis, right, in the world economy, that may have an impact on our economy because we are highly depends on the debt, no, right? Borrowings, no, right? If there's a crisis in the external environment, we will not be able to borrow, no? So that will be affect to the internal economy as well. And maybe the foreign exchange crisis, no, right? Other financial crisis, no, like that, stock market crisis, no, other stock markets, if there is a collapse in the stock markets, no, right? So that will affect to the our markets and also our economy as well, right? And also it can be positive or negative, no? Shocks can be positive. So that means some shocks may generate benefits to the economy, no? Sometimes it may have a cost, no? Right? So if there is a drought, something, flooding, landslides, there may be a cost, no, right? And some other positive shocks means now sometimes we get if there's some benefits from the external donations and like that. If we take the tsunami case, no, right? And tsunami, right? So there's a positive effect also, no, since we received more and more donations, no, right? And other aids, no, foreign aids like that, right? So like that, we can identify those the policies and the shocks, right? So the shocks also we need to control, right? So if there is a negative effects, no, right? So we need to take some remedial actions to control, right? To mitigate the impact, no, right? On the macro variable, spreading further like that. Right? So that also be identified. Then we talk about the national income, right? So different, we identified the meaning of the national income, no, right? So that is simply what is it? It is the total production, right? So that is the overall performance of the economy, right? Final results of the economy, right? How we measure, so we can assess it, right? So by looking at different methods, right? So we talk about the double counting, right? Because if we take the same thing twice, no, right? Repeatedly, so that will double count the national income. That will they overestimate the national income, right? In order to avoid that, right? Because covering overall economy, we are calculating the overall performance, no, right? It's not a simple task. There are some approaches, no, right? So we need to use the value-added method or the final account approach. And then we talk about now. Finally, we stop here, right? So the others are joining. We will continue, right? Because otherwise we have only 2 days, right? So I have announcement also regarding your assessment. At the break time, I will talk with you, right? Now, how do we measure the national income? So there are 3 methods we identified here, right? So output method, no, right? So based on the total product, no, right? Produce, no, during given period of time, right? So we valued all the goods and service produced, no, right? And their monetary value, no, right? We assess. That is based on the output method, no, right? So covering overall economy, maybe it's basically highlight what is the total production in the agriculture, right? And the manufacturing sector and the service sector, right? So like that, right? So we value all the goods and service produced. That is the output method means. So that is the monetary value of all the goods and service produced within the country, right? During the given period of time. And the income method means based on the factor income, right? Received by the household, right? So those are the rent, wages, interest, profits, right? So those are the rewards, for the factors of production. Based on the rewards on the factors of production, right? So we can value how much we received as a rental income, right? How much we received as a wages, salaries and wages, profits and the interest payments, right? So based on that, right? That is the income method, right? Based on the factor income. So if we add all the income received to the household in different forms, right? So that will count the national income, right? According to the income method. Expenditure method means based on the expenditure made to acquire the goods and service produced, right? So that we incurred in the market, right? So that is we measure the national income based on the final expenditure that we made, right? So how much we paid for the consumption to acquire the goods, that is the consumption, investment expenditure, government expenditure, expenditure on exports that we produce for the rest of the world, right? So we made expenditure to produce goods for the export market, right? So if we calculate all these things, consumption expenditure, investment expenditure, government expenditure, and expenditure on exports, right? So those are the final monetary value that form the expenditure that we made on the goods and service, right? So that will count the national income. So that is the GDP, right? According to the market price, right? Key value, right? So those are the 3 methods, right? According to the output method, if I do so, output method means scale, right? Output, right? So we calculate all the goods produced, right? So if there are X number of goods, right? We value all the goods and service produced, right? So this actually explains that all the production, how much we come from the agriculture sector and the manufacturing sector, right? And the service sector, right? So we are the contribution, right? Coming from agriculture, manufacturing service, right? So that is you value the goods or national income according to the output method, right? So these outputs are coming from different sectors, maybe the agricultural output, industrial, and this also includes the service that we provide. Because in the we say the output mean or the product mean goods and service, both are included, right? So that we have idea about the economic structure, right? To analyze these things, right? We can get idea about the economic structure, right? So that's why we talk about the economic structure, contribution coming from the agriculture sector, manufacturing sector, service sector, right? We observe what is happening, from the last 30, 40 years, right? Contribution from the agriculture sector increase, right? Even manufacturing sector stagnating, right? Service sector slightly increased, right? We observed that last time. Right? So the other one is income method means income how we calculate, that is the rent, wages, profits, interest, right? Based on the factor income is income. So this is the profit mean. This is the gross income, right? Gross profit, right? So, even though now we calculate the profit here, right? For an example, right? The firm's total profits generated, right? So some profits are reinvested, right? Therefore, there's a problem arises, right? Even though profits are there, right? Sometimes companies are declared, as dividends, right? So the profits, right? You know it, right? So that means those profits may reinvestment in the business, right? So there's a weak point, right? So anyway, according to income method, he identified the factor income, that is the gross domestic income, GDI, right? So this is the GDP, the domestic product, right? And the expenditure method means how much you get consumption, how much you get investment, and how much you spend by the government, goods and service, and the expenditure on exports. So this is the export spending. Expenditure on exports. Right? So that form all the expenditure. That way also we can account it. These things are actually equal, not kind. So these are the different approaches that we use, right, to analyze the overall performance of the economy. So basically the gross domestic expenditure, right? GDE, right? We take the consumption investment over this, right? Now, if I tell you one thing, we analyze this now. Here we take domestic, right? There does not include the imports. No? Do you agree or not? Are there imports? Imports of the domestic, right? And there is a two different versions, gross domestic. Domestic product and product, right? Okay, right? Domestic means regardless of the ownership, we calculate the government output products, right? Within the residence, non-residence. Within the geographical area, how much production? That is the gross domestic. Our national needs, our residents, they produce in the outside countries also. Our production plants, we take into account all these things. That is our national system, right? Regardless of the location, right? We are not worrying about the location. Here also in other countries as well, right? So we take into account all the production output produced by the nationalists, right? Locally or internationally, right? there is the gross national output, right? So like that, right? Now here, there is gross domestic expenditure of this one, right? Does not include imports, no, right? For an example of this, if we classify this one, right? So that is the GDP, right? Today, GDP, GDP, all these things are equal, no? Right? If I mention this one, right? That means GDP, all these things are equal, right? We take the GDP, this is A plus, I plus, E plus X. Now here, GDP means Y is C, consumption. This is, if we analyze this consumption, we spent on domestically produced goods, not right? Consumption of domestically produced goods, not right? And also we consume foreign goods, not right? Right? And the investment on domestically produced goods, investments on foreign goods, right? Right. And the government expenditure also, domestic and the foreign. Government expenditure on domestically produced goods, no, right? Because government also consumes. So, and the government expenditure on foreign goods, no, right? So that is the then exports, no? That is the expenditure on exported goods, no, right? We take that. Now here we take the domestic part on which here, no, right? And we exclude foreign here, here, and here. We exclude those things, no, right? So those are the now this is the C, we say C plus I plus C, that is we take the domestically produced goods, no, all these things, no, right? And we say C plus I plus C plus X minus M. M means these are foreign expenditure on foreign goods, no, consumption, investment, government expenditure, right? So that form the imports, right? Or imports, right? We deduct that from, right? Right. We measure the gross domestic expenditure actually, right? Right. So we exclude that, right? Right. So that is the now we measure now this output method, income method, expenditure method, no, right? So that is called national income accounting approach. According to the national income accounting approach, we identify these methods, no, right? Output method, income method, expenditure method, no, right? So then what is social accounting? Because there are other approaches, no, right? When we are measuring the national output overall performance, there are alternative ways, right? Those are all methods of this measurement methods, right? We identify as social accounting. Right now, one thing is that is national how we measure national income accounting approach, no, right? Then there are other methods, right? That is called one is called output, input output method. Input output approach, no, right? There's going to be inputs and the output, no, right? We can measure, no, right? So in the production process, what are the inputs we operate, no, right? And what are the outputs, no, generate through the process? By analyzing the input and output, there are input output tables, no, right? And the other one is balance sheet, national balance sheet approach. National balance sheet. The balance sheet means you know assets and the liabilities, no, right? So by taking the national level, no, both assets the liability, we can measure the output, no? Right. And the flow of funds approach. Flow of funds approach, no? Right. Flow of funds inflows and the funds outflows, no? That is the cash flow, no? By analyzing the cash flow, covering overall economy, no? Right. Fund flow approach, right? And these are the methods that we can use to measure the overall performance of the economy. So that is called social account. Okay, whereas social account, right? So there are, but we look at this national income accounting method, right? That is the output method. So this has some methods, output method, expenditure method, income method, right? So in national, when we are measuring the overall performance of the economy, right? Right. So then now we have, as we discussed earlier, right, we identify different concepts are there, right? PVP, PPE, no, PPI, no, right? Like that, right? Based on the three method that we use. So the GDP is the total output produced, as we discussed, no, right? Within the geographical area, no, right? GDP, right? Regardless of the nationality, no, right? We take into account only the location, right? Within the geographical area, right? So how much we produce within the particular geographical area, right? Srilanka, no? That is the GDP. So that is GDP, gross domestic production. The monetary value of total production within the bound, no? Right? That means nationals or other national foreigners, right? If the foreigners come here, no? If they produce, that also counted, no? Under the GDP, no? Right? Foreign investment, so FDI, no? Right? If they establish now the so many branches, now the outlets, right? Companies, no? Under that BOI, no? Right? Companies, no? All these things we take into account. GDP, no? Right? Here we take into account only we consider the location regardless of the nationality, right? And that's actually we can calculate by looking at the contribution coming from the agriculture sector, industrial sector, service sector, right? So the GDP means contribution from the agriculture, contribution from the industry, contribution from the service. GDI means based on the factor income, right? So there is the rewards, right? Rental, rent income, wages, interest, and profit, right? So this is the gross domestic income, right? In gross terms, right? It includes the depreciation as well, right? Let the profit be gross profit, right? Okay. And the expenditure method means based on the, we look at the final stage, no? When we are making the expenditure, no? Right? Based on that, we calculate the national income, right? Based on the expenditure, we may acquire the goods and services, no? Right? So that form the common expenditure, private consumption, public consumption, and the gross domestic formation means investment, no? Right? Consumption expenditure, so that is the private consumption. Common expenditure means common consumption. We denote as G, right? Private investment, private consumption is C, Gross domestic capital formation means I, investment. That is the private investment. And there are, most we have done in advanced level, this gross domestic capital formation has two parts, no? Right? Plus fixed capital formation and change in investment, right? So that is the investment, private investment. Plus domestic fixed capital formation, right? So what you spend on this land and development, irrigation, there are so many. Yeah. Right? And the change in inventory is also there. Right? That form the investment. Right? So that is the expenditure, right? TD. Okay. Now then we can look at the different ways in our, as we mentioned, right? So one is the difference you can understand. One is the difference between the GDP and the GNP, right? So what is the adjustment we made for GDP, GNP? Can you remember? What is the adjustment we made? The adjustment. Now the GDP is the gross domestic product, no, right? That is the monetary value of all the goods and services produced within the boundary of the economic growth, right? So that how we convert that one into the GNP. We add the net factor income from abroad, no, right? Particularly Videshi Prasad Kadai here, right? Factor income received, factor income payment, right? We adjust that component, right? We have to convert the GDP into GNP, no, right? Net factor income from abroad. This one, right? Net factor income from abroad, right? So that is the difference between the factor income received and the factor income paid for the other countries, no, right? Sadhaka levy, no, Sadhaka giving, right? Factor income received and the factor income. So that is the net factor income from abroad, right? Yeah, just the net factor income from abroad to the GDP, and we can derive GNP value, right? So GNP means the total output, national output, right? So that actually includes all the production, so the output produced by our national, no, right? So regardless of the location, no, right? Domestically or in other countries as well. That's why we have this net factor income output, right? We deduct the factor payment, those who produce foreigners, no, if they are produced here, we have to pay the factor, no, payment for them, no? We deduct that one, no? And factor income received, because our people, they are in other countries, they in the production process, now we receive some factor income, no, right? So we add that one, right? So that's, we add this, right? So normally, net factor income from abroad with Sri Lanka is negative, no, right? Factor income payment is higher than the factor income received, right? Because we pay for the others, right? Since they are highly involved, for instance, right? Factor payments are higher than the factor received. So therefore, GDP is higher than GNP, right? So GDP minus net factor income from all. Let me receive the GNP, right? Because this is negative. Net factor income is negative, right? So GDP is higher than GNP, right? Simple factor payments are higher than factor received, right? We adjust that one, right? So to convert the GDP into GNP, right? Okay. So that is the domestic output and the national output, no, right? Now, if I summarize all these things in the one paper, right, you can, because you are memory, right? So you are doing before these things again, right? Simple concepts, right, behind the things, right? Or the output. So basically, we talk about in two ways, right? One is the domestic output, right? And the other one is the national output. No? Domestic, national, no? That's two concepts, no? That we identify domestic product, national product, no? Right? Domestic product. This is the production. National product, no? Right? Right? Okay. Domestic product. Then domestic product we calculate how gross net, right? So that means gross domestic product. Gross domestic product. Gross domestic product. Net domestic product also we can calculate. Right? Okay. Now what is the adjustment we made here? We enter manufacturing income from also. in order to convert domestic into factor, right? And here also we can identify the gross net. Here gross domestic output, net domestic output. Right? Then we have gross national output, net national output. Right? So how we calculate the gross, how we convert gross into net? We make the provision for the depreciation. Right? Depreciation. Right? The gross starting depreciation we deduct, right? We deduct the depreciation, right? From the gross output, we get the net output, right? Then also gross minus depreciation net, right? So that means gross national output. You can calculate net national output, right? Gross domestic output, net domestic output, that's different concepts, right? So like then how we calculate further? Can you remember? We calculate these things according to the factor cost and the market price. You also factor cost, market price. You also factor cost, market price. You also factor cost, market price. Right? Then what is how we explain cost? Domestic output at factor cost price. Gross domestic output at factor cost price. Gross domestic output at market price. Right? Right. Net domestic output at factor cost. Net domestic output at market price. Right? Gross national output at factor cost price. Gross national output at market price. Right? Net national output at factor cost price. Net national output at market price. We can explain the output. No? Now, normally, when you prepare the central bank report, you see at factor cost price. No? Right? Normally, the factor income we measure at factor cost. No? Right? Gross domestic income at factor cost price. No? Right? So we can take the now GDP. No? Normally, the out expenditure we measure market price. Right? We measure the expenditure that normally we express according to market price. Right? Expenditure that is related to the expenditure at the current market price, right? Use the market price, right? How do you calculate? And we have the gross domestic output and factor cost. How we convert to the gross domestic output and market price? We add the taxes, deduct subsidies, right? There are indirect taxes. We add taxes to the factor cost price, deduct subsidies. We will arrive market price. We have gross domestic output and factor cost, right? What we add is net taxes. Output and factor cost and net taxes. We will receive the EBP at market price. Right? Net taxes means we add taxes minus subsidies, no? Right? Difference between the tax and the subsidies, no? It's the net tax, right? Right. That is something, right? Okay. So we have the factor cost price, market price, no? Another concept. No, there are different concepts we can identify, no? Right? Gross domestic output and factor cost. Gross domestic output and price, right? Net domestic output and factor cost, net domestic output and market price, like that. Then we can measure the gross national output and factor cost, gross national output and market price, right? Net national output and factor cost, net national output and market price, right? So like that. So then we express further, no? Right? Can you remember? So factor cost and the market price related to at current price, no? Constant price. Current price, right? At the prevailing current price is what? If we express anything at the prevailing factor cost prices, so prevailing market price, right? That is the current price, right? Current price can partner with පවත්නා පවත්නා වෙළඳ මිලට වෙන්න පුළුවන් පවත්නා සාධක මිලට වෙන්න පුළුවන්. Current price at prevailing factor cost price or prevailing market price. That is the current price. There are two more, right? Prevailing factor cost price එකකට ගන්න පුළුවන්. So we can take prevailing market පද තියෙන වෙළඳ මිලට market price එක we can get. So based on the current factor payments, right? The current price. And the constant price means what? What is constant price? So we remove the price differentials, right? Constant price is by removing price changes. So that is very important, no? Right? That is real term, not right? So that is the real output, no? Right? That in real terms. Real terms. So that is very important, right? Normally, output growth, GDP growth, you have to measure in real terms, right? So that means at constant price, right? Normally, output growth we measure at constant price. So how we measure the constant price? You can see the base year, no? Right? We take the base year price, no? Right? And we value the today output based on the base year prices, no? Right? Right? So base year price may be 2015, no? So we take the prices prevail in 2015 and we value the today's output, right? Based on the 2015 prices, no? Right? So we can use the base year, no? Right? Here the base year. So we can measure the constant price based on the base year, no? Right? Base year price. You can see when the central bank reports, you can see the base year. We take it as 100, no? Right? Base year we take it as 100, right? And then we see how the price change. Right? And the other one is we can use DDP, price index, okay? And we can calculate the constant price, right? So the price index, so see if we take the nominal GDP divided by the price index, we get the GDP at constant prices, right? Right? Okay. So that is there are two ways, right? Based on the base year or the price index, we can calculate the price, right? So we will see that one way, right? Right? Now this is the how we can calculate the current price, constant price, right? Constant price is very important. Current price always increase, right? And time, no? So because price also increase, no? Other than the price, you know, negative. So when you value the output also, it increases year by year, no? Right? If you look at the central bank annual reports, so GDP at current price and the market price always increase, no? Right? If you value the output growth according to the current price or the market price, output growth is very high, right? But we are not using that one to measure the growth, you know, economic growth. We need to look at the real physical change in output over the years, right? So that's why we use constant GDP, right? To measure. And we compare with the previous year GDP, no, and identify the difference divided by the previous year GDP into 100. That measures the economic growth, right? Changing output compared with the previous. Right? So for that we use the constant price, right? And here also we can measure current price, constant. Sometimes we just use that one, right? Anyway, concept is that, right? So here also current price, constant price. There are so many concepts are there, right? All things are current price, constant price, no? Right? Okay. So current price means at the prevailing market price or prevailing factor cost price, right? Current price means prevailing market price or prevailing factor cost price. Constant price we measure based on the PSD or based on price index, by determining the price differentials. We take the real output, right? So that is now how we can explain. First, domestic output at current factor cost. Right? First, domestic output at current factor cost. Right? Then first, domestic output at constant factor. Right? Right. So we can take first domestic output at also. Sometimes we just not use that one, right? Because domestic output at current market price, constant market price. We are not taking the constant market price, right? Only meaning, there's no meaning, right? Anyway, right? Net domestic output at current factor cost, net domestic output at constant factor cost, right? So like that. Net domestic output at current market price, net domestic output at constant market price. Like that. Gross national output at current factor cost, gross national output at constant factor. Like that way, there are so many concepts are there. You can elaborate. You can identify. Those are the national income concepts, right? All these things explain. How many concepts are there? Right. Very important is factor cost, market price, current price, constant price. Right? Okay. Is it clear? Right. We can identify. Basically, we identify GDP and the GNP, not starting from here, domestic and the national. Right. Right. So domestic, we are just expecting income from abroad. We take the national because factor income payment for the foreigners, no, we deduct from here, no, right? So we take the national output, right? Because we take the our nationals produce production, no, right? So that is we take the ownership, no, right? We take the ownership. Here we look at the location, no, only, right? We are talking about the location here, no, right? Only, no, right? Not the ownership, no, right? Here we worry about the ownership. Not the location, right? Not the location. That is the difference, no, right? Plus, obviously, Canada, right? Here we talk about the location, not the ownership. Here we talk about the ownership, not the location, right? So that is the difference, right? Okay. So then now we can identify this one. Right? Now given the same thing, right? That we discussed, no? Right? Now we have given the years, 1, 2, 3, 4, 5. Current price GDP, right? So that is the current price, no? GDP at current price. Then maybe the factor cost price or the market price, maybe, right? Current factor cost, current market price. Because it's the current price, right? So now we see here the current price always increase, no, right? Because with the price changes, no, right? With the inflation, if you measure the GDP at current price, so always increase, no, right? You see, it's including the price differentials, no, right? Price changes include here. Now we want to remove this price changes from this. Right? So we take the GDP at constant price. So we can, in other words, so there is the real GDP, right? Constant price means real GDP, right? So how do you take the real GDP? I mentioned two methods, no? Right? You can use the base year method or the price index, right? Now the base year method, now here we use the price index, right? Now here we have the GDP display. What is GDP display? Sorry. What is GDP display? So that is called implicit price index. Implicit price index. Implicit price index, GDP display. Right? Normally we use that term. Inflation, right? So since it double overall they come up, the total product. So it's they come up, right? So the GDP display. Right? So that's actually how we calculate GDP display. Nominal GDP divided by the constant GDP into 100, right? Here GDP should be nominal GDP means current GDP, no, right? And divided by the constant GDP, real GDP, right? Into 100. Then the price index, no, right? Implicit price index, right? Nominal divided by the real, right? Into 100, right? Nominal divided by the real, which is divided by the real GDP part. That will count the GDP inflation, right? So if we take this one, this is the GDP inflation by calculating the nominal divided by the real. So that you see that index always exists, right? Year to year. So this is the starting point. How we calculate the constant GDP? Current GDP or the nominal GDP divided by the GDP inflation, right? Constant GDP or real. Real GDP, how we calculate? Nominal GDP divided by the GDP inflated into 100, right? So that is the real GDP, or constant GDP. So we can see 1000 divided by 100 into 100, it will equal to 1000, right? So that is the constant GDP, real GDP. 1200 divided by 109.1 into 100, that is equal to 1001. So that is real. We remove the price differentials. Here, we remove the price changes using the price index. Price index is the indicative stage. So that is called implicit price index. Lanka, Galle, Avadam. Lanka, Galle, Avadam. Implicit price index. Okay. So that is you can see. GDP divided by that. So we will arrive with these figures, right? So that is the real GDP. So this is the real GDP, right? How we measure the economic growth? How we measure the economic growth? We take the first year, and the second year. Economic growth in the year of one. So the current GDP is like this. 1000 into 1100, 1100 minus 1000. So that is the change in the real GDP compared to the previous year, right? Divided by the previous year GDP is 1000, right? Into 100. That means 100 divided by 1000 into 1000. Right? It's 10% growth. Okay. That's a 10% growth. How we calculate economic growth? Take the difference, right? Yes. And divided by the previous year GDP, into 100. That is economic growth. So we use this constant GDP to measure the economic growth, right? Right, and the other one is base year. This is the using the price index, right? We calculate the constant GDP. Other one is the base year. Based on the base year price, the base year is base year is 2016, right? Now the economy produced yes, two products, right? Economy produced two products, A and B. Okay. If economy produced two products, product A and B, right? So how we value the goods? Our GDP. The current year is 2020, let's say 2023, right? Right. How we value the 2023 output? Price of the product A into quantity of product A price of the product 2024, 23, quantity produced in 2023, right? Plus EAPB 2023 into QB 2020, right? We value that one, that is, what is that? That is the GDP, no? Current GDP, right? Okay. Right. And we value the GDP, right? This is the current, right? Constant GDP, how we get? Constant. The current. Constant, how we calculate? So we take the price of product A in 2016, base year price, right? And then current quantity in May 2023. So we take the price of the B 2016 and QB 2023. That is the constant GDP. Now we value the goods based on the base year price, right? So that is the base year, right? So we can calculate the GDP deflator also based on that, right? Taking the current GDP divided by the constant GDP, no, into 100, no? This part divided by this part into 100 means GDP deflate, right? So like that, simple example, right? So here the difference means we take the base year price and the current quantity. So we value the goods based on the base year price. So there is a constant GDP based on the base, right? Right. Now then we'll start the other reports, right? Now these are some of the things just you can talk about, right? What is the importance of measuring national income, no? Right? Basically, once we measure our performance, no, right? So that say something about our status, no, right? We measure the national income, maybe the GDP or the per capita income, no, right? There's a rise in the per capita income, our status goes up, no, right? If the growth rate accelerates, our status goes up, no, right? And we say something about the current status and the government progress, right? Right? Now that can be used, we can use for the compare, no, right? In the previous years, no, right? And we can analyze the development, right? So what is the progress, no, right? Compared to the previous years, historically. And we can compare with the other nations, no, right? Right? Comparison purpose. And there are other uses of measuring national income, you know, right? So it's to measure the living standard, improvements, right? So what is happening to the employment, no, right? Like let's say just again, so it can be solved. So, but there are some issues also, no, right? So can we think because issues, right? How can we figure out? So what we do is the non-monetized ratio, right? Are we going to improve the ratio that we spend, right? So there are two things, working and the ratio, right? Equal the ratio, but we are not including that one in measuring the national income, no, right? Non-monetized, because we are it's not in the monetary terms, right? We have to convert it to terms and see, right? We add anything, right? The ratio enjoyed by the people, so that is not reflecting the national income. And the quantity of inputs used in the output, we are talking about the output products, right? And the material that we use. There's no idea, right? That is the other. And the exploitation of resource exploitation, right? So we can increase the output even, no, right? Suddenly, no, right? One day, right? Exploiting the resources, right? Cutting down trees, no? We can increase the output, no, right? what that does not actually include, right? So what happened with the environment, right? What happened with the resources, right? Regulations, and the damages, social and natural environment, policy. Informal economic activities, right? Only we take the formal, right? Market, right? The goods are come to the market, we include it, right? Some goods are not coming to the market, right? Some activities are done in informal, right? Or even though now it's an informal market, right? Right. So we only consider the formal market setting, right? And we measure the national income, right? But there are a lot of transactions took place in informal, right? Sometimes you borrow from your friends, right? From your parents, right? Right. Right. And there are some other people are using remote areas, yes, formal market. There are a lot of transactions took place informal, right? Right. Sometimes they are working without any payments, right? Formal and produce some goods, control markets, right? So these things are not included. And the underground illegal activities, right? Are we going to include that also? Because if illegal, then it's not included in the environment. As there are things. In the economic value of domestic work, right? Housewife activities, right? Some other important effective transactions took place. Sometimes we are not regarding all these things, right? So if you construct a road in the, like that way without paving versus in the rural areas, right? Like it's another something, right? So that is effective, but those things are not included, domestic work. Right? So like there are likewise many problems, right? About it. Okay. Right. So the circular flow, right? Can you remember circular flow of national income? That's actually the national income, right? So how do you like or in macroeconomics we talk about this now we are going to measure the national income, right? So we need to talk about something about the equilibrium, right? Macroeconomics. When we talk about the microeconomics, equilibrium in the market, right? Microeconomics, since we are looking at the overall economy, right? We have to think about the equilibrium, right? The equilibrium situation. So they are also equilibrium. We talk about the overall economy, right? That is called national equilibrium, right? So there actually we can identify this when you explain the equilibrium situation in the overall economy. So there are different players, right? Different sectors are there, right? The economy, and interact with the markets, right? So first we take the simple way, right? So that explains the simple circular flow, right? Of national income. Right? So we take the two sectors, household and the firms. How those firms interact. What is the behavior between the household and the firms? So that explains the simple circular model, right? So in a simple circular model, explain basically the real and the monetary flows, right? Operate on their opposite direction. Household firms, firms to household. Like there is a real flow and the monetary flows. We purchase goods from the firms, right? Consumption, and we make the payments also, right? Expenditure. Expenditure is the monetary flow. Goods we receive from the household, firms to household, that is the supply of goods, that is the real flow, right? And the firm's demand factor, right? We supply the factor, right? Firms pay factor payments, right? So there's a real flow and monetary supply of factors in the production process. Like that, we see the interaction between the household and the firms, right? When you talk about their behavior in the economy, right? So that explains the simple circular model. So that actually explains the interaction between the household and the firms, right? And what kind of flows, real flows and the monetary flows occurred on their direction, right? So we will explain that again, right? So that actually in the simple model even, right? We can provide useful information in order to analyze the economic behavior, right? And that can be uplifted to the full-fledged model, by considering other sectors, other markets, and so on, right? So that is a simple model provide, that's why we say it's provide the basis for to macroeconomic analysis. Starting from the simple, then we can incorporate other sectors and the other markets into our model. So that will explain the full-fledged macroeconomic model, overall behavior. Different sectors. Now we have the different sectors, right? Household, firms, government, external sector, right? So earlier we take this household and firms, right? Simple model. And if you explain other sectors, government sector is there. And the external sector, that will cover overall economy, right? And we see how these all these sectors behave, right? That is very right? Now, in a simple model, there are some assumptions. Yes, you do sectors, right? Only the household and the firms. So there is no savings because all the income received, they consume, right? There is no savings. Right? If there is a saving, it's a kind of outflow from the market, right? So for simplicity, we assume no savings and then no investments. And there is no stocks, right? Unstocked, unsold stocks are not there. There will opening, closing balances are not there, right? All is produced, consumed, right? No government involvement. And we assume the loss economy, right? Simple. If there is a government involvement, this creates right? In that model, we identify this national data, right? And considering the interaction between household and side. So that can be used to how we measure the national output, national expenditure, national income, right? So that explains those things if we take the overall figure, right? If we generalize to the overall economy, we can identify these variables, macroeconomic aggregates, by looking at the simple. So number one, right? So national income, national output, national expenditure, right? So those are the same thing that we look at in different points. Right? Now, this is the simple model, right? Here we incorporate the market goals, right? Because the sectors, in order to explain the smooth functioning of the sectors, right? We include the market. Without market, there is no smooth function, right? How these real flows and the monetary flows occur through the market. We need market. Now, in between household and the firms, right? We have the goods market, right? And the factor market is there. So the interaction when we explain these goods sectors, that will happen through the market. Now, the household purchase goods, right? So demand goods, right? Okay. Demand for the goods. And the firm supply goods, right? That form the market forces for demand and supply, right? Right? So that determine the price. Based on that, the payment by the household for the firms will determine, right? Based on the price determining the market. And the income, sales, turnover for the firms that will determine the quality. Right? So we see the real and the monetary flows, right? We now student for right? And the other side, the factor market, right? So when there is a demand for the production, we go there, one has to produce it, right? So for demand factors, right? So the for demand factors that mean the factor demand, the factor demand, and also supply, right? Then the factor supply. So factor demand and the factor supply. Labor demand, labor supply. That form the market forces. finally determine the factor price, basic price. Based on that, we determine the expenditure from the firm's point of view to acquire the factors in production. And that the side is the firm's point of view, factor owners, that determine the factor income for them, right? So we see the real and the manufacturer supply, the real supply, factor income received as a opposite relation. Here, the factor payment is know that, and they receive the factors of production, right? So which has the productivity is also there, right? So the production. The real and the market also for it. They are so this is not a complete model, right? It's a simple model. We can explain on the market for the but the overall economy, there are other markets, right? Money market, foreign exchange market, right? And the sectors also, not only two sectors in the overall economy, when we explain the behavior, we identify the government sector and the foreign sector. We need to incorporate all these things into the simple model. So that explains the complete model, right? And then we can see the interaction between these sectors and the markets. So when we explain the overall economic behavior. So that explains the overall economy. Right? So that actually now you can see here, right? We incorporate this government sector, right? And the foreign sector, foreign economics, foreign sector. We are exporting and importing. So right, that is the foreign sector. Forex market, right? Like I explained, the externals. The government sector is there, apart from the factor market and the goods market, we see the money market, financial market. And we can see how these sectors are interact each other through the market. So previously we say there, right? Factor market and the goods market. Now we take the government, right? Now household receive income by supplying the factor. Based on that, what they have to do? Part of the income they consume, other part they save in the financial market, right? Right. So also a single income, that is the factor income, that is the income, so right. From the income received, right? So part of the income saved, other part pay taxes to the government, based on the income tax. Right? That is the payment, tax payments, savings in the financial market. And the firms receive the sales revenue, right? Based on the sales, they have to pay the VAT or something, right? Right? Taxes in the government. Firms also, right, receive pay the taxes, can incorporate that one, that is what the taxes in the government, right? And other side we see here, right? We take the government, right? Now, government mainly the income is the tax income, received from the household, income tax, and the from the business, VAT, overhead tax, right? So that is the main source of government revenue. So based on the revenue, government determine the economy, right? We can't explain it when it all good sense, right? So that is the government consumption, right? And then it's a second government purchase. So part of the income received, right? Tax income consumed. That means government spent. If there is a difference between the expenditure and the revenue, let's explain the budget, right? If there can be a surplus of the deficit, right? If there is a deficit, what happens? Government need to borrow from the financial market. If there is a surplus, government can invest in the market. You can see another case like data and price. We can combine these sectors in the market, right? So that we explain the activities. Even in the foreign sector, so that we exports and the imports, right? So the foreign exchange, we pay the foreign exchange, right? Foreign exchange market, right? So that explains the full-fledged model, right? Of when we explain the overall, right? Okay. So this overall is understand, right? Okay, right. So then now we talk about the macroeconomic equilibrium, right? So we already know the market equilibrium. There are two conditions, right? The market equilibrium. Those are two conditions. Demand equals supply, no, right? Literal demand or market demand equals to the market supply, right? Other one is there is no excess demand, no excess supply. Excess demand equal excess supply equals to zero, right? So there is the market equilibrium. But when you explain the macroeconomic equilibrium, it is different from that, no, right? Because it will explain the overall economy, some kind of stable situation in the overall economy. In that case, what happens? Aggregate demand should equals to the aggregate supply, equals to the aggregate expenditure, no, right? At the equilibrium point, right? And another one condition is injection is equals to the withdrawal. Injection is equals to the withdrawal. That is the two conditions. One is the aggregate demand, because our tool that we use, no, right, in macroeconomics, ADA is no aggregate demand, aggregate supply. We are not referring to a demand for the particular goods, no. We refer the demand for the goods in the overall economy, for all the goods and services, no, right. So that was the aggregate demand and the overall supply, right, all the goods and services produced, right. So that equals aggregate expenditure, right. So that is the first condition. Aggregate demand should be equal to the aggregate supply. And the other condition should be injections should be equal to the withdrawal. Right? So there are injections at the withdrawal. Right? Now this aggregate demand, you know that aggregate demand equals C plus I plus B plus X minus N, right? Or GDP or income, no, right? You can take this, right? Aggregate demand equals C plus A plus B, X minus M, no, right? And the injection is equal withdrawal. So that is the condition, no? Second condition. Can you explain the equilibrium? So equilibrium, that is a stable situation in the overall economy, right? It's a kind of stability, no? Steady level in the overall economy, right? So that could be happen, right? When aggregate demand equal aggregate supply, or when injection is equal withdrawal, right? So, right, these two conditions should be satisfied in order to establish macroeconomic equilibrium, no, right? So now here, what are the injections and what are the withdrawals? Now expenditures will be equal to the income, right? Or aggregate supply means income, right? Aggregate expenditure should be equal to the income. That is equal to the aggregate demand. So that is called planned expenditure, right? Should be equal to the income. Because at the equilibrium point, these expenditure are for planned expenditure, right? For the case version, right? Planned expenditure should be equal to the income. Right? So what happens if there is a expenditure is higher than the income, right? So that is something that is equilibrium situation, there is an adjustment. If the expenditure is higher, there is a rise in the income. If the expenditure demand is high, then the income. So that will increase the income. Another way of it can be done. Right? Right. So what is the injections and the withdrawal? Okay. So injections and the withdrawal. So injections, that is the important condition. No? So those are the inflows. Inflows to the national income model. These are the outflows. Right. At the equilibrium, we know that inflows will be equals to the outflows, right? So withdrawals are the linkages. No? We call it as linkages, like is linkages. No? So those are the outflows. We can calculate the inflows and outflows, right? So inflows has positive impact on national income, outflows has negative impact on national income, right? So injections are the amount which inflow to the circular model, right? So those are the inflows to the circular model, which has a positive impact on national income. If there's a rise in the inflow, that will increase the national income. Right? If there's a decrease in the inflows, that will decline the national income. So withdrawals are the outflows from the circular model, which has a negative impact on national income. No. Higher withdrawals means to decrease the national income. Right? Now, what are the inflows? One inflow is the investment, government expenditure, and the exports. Those are the inflows, which has a positive impact on national income. Raising investment means it raises the national income. So when investment increases, that's a part of aggregate demand. Aggregate demand increases because aggregate demand equals plus I, no, right? Right. When investment increase, aggregate demand increase, when aggregate demand increase, income also increase. Right? Because demand creates its own supply, right? So demand side factors pay, right? That will affect the supply, income also increase. So that is the positive impact. Same way, government expenditure is also part of aggregate demand, P plus L plus G. Right? So then government expenditure means aggregate demand, income. Export also. So that's how we export to sell service to the other nation. That is exporting those are autonomous expenditure. That also increase the aggregate demand and income. So the outflows are the savings, no, right? Taxes, imports, no, right? So those are the outflows, no? Savings are outflow from the model, right? The outflow from the circular model. Right? Only we assume savings, there is no savings. No? So if there are savings are out, investment is an inflow, savings are out. Taxes also same, right? It's a rebate. Imports also out, which has a negative impact. If there is a high tax, what happens? Tax effect become income tax, no? Right? Now the high tax that will cause to when the rise in the tax, that will regulate disposable income, YD, right? Because YD how we calculate? Nominal income minus tax, no, right? Y minus T, no, right? Disposable income means YD, no, right? So when you receive the income, right, you have to pay the taxes based on your income, right? The rest part you can consume or invest, no, right? After paying taxes, no, right? So everything depends on disposable income. No? Consumption depends on disposable income. So when tax increase, what happens? Disposable income, because it is by the increase, right? Disposable income reduces. When there is a decline in the disposable income, that reduces the consumption. So when consumption decreases, that will reduce the aggregate demand. Of course, it's a part of aggregate demand. No, right? Those it's one element of the aggregate. That also reduces. Then income also reduces, no, right? As a result. So when there is tax, high tax, income, so the output reduces, no, right? In the economy. And demand side analysis, right? So there is the tax paid, there is the supply side analysis also there. So this is the demand side explanation, right? High tax will reduce disposable income, right? Tax has negative impact on national income. Imports also same, right? Imports also same. Yeah, imports, right? What happened? import function, we can import mainly depends on the income, right? Right. So the import function you can write M0 plus My. Right. So this is the import part. Import depends on the M0 in autonomous imports. Right. So simple length means what is simple length? Because import depends on the income, right? So there are other factors. Simplicity assume, right? Imports depends on income. When income level increase, imports also increase. When our income level increase, we demand more foreign goods, no? Right? We actually, local goods remain, we demand foreign goods, no? Imported goods, no? Right? Because when your income level increase, there will be a demand shift from locally produced goods to foreign goods, no? Right? So we prefer foreign goods, no? Right? So therefore, what happens? When income increase, imports increase, no? Right? Is it true? Is it true? Can positive impact? Yes, no, right. When income level increase, people demand more for inputs, right? Imports also increase. So this is simple lending. What is simple lending? That is called marginal propensity to imports. We are going actually something beyond, right? The marginal propensity to imports, right? But we must know, right? It's inside. That is what is it? Marginal propensity. When income increase, how much the imports increase? That is given by marginal propensity, right? Marginal tax, no, right? Now the marginal, this is the investment function also, there is a marginal something, right? So when investment increase, mainly depends on the interest rate, no, right? So there is something interest elasticity of investment, right? Because when interest rate increase, investment decrease in a different way based on the interest elasticity, right? So in the elasticity concept that, right? So here marginal propensity to imports, right? So that is the responsiveness to import due to change in the income, national income. So when income increased by 5%, how much? The import increase given by the marginal propensity to import, right? So that is a simple length, right? Now here, what happened? Imports depends on income, right? So when there is the price in the imports, what happened? There's the argument, right? So why we deduct the imports? I import, reduce the national income. Why? Aggregate demand that is equals to income, no, right? I imports, reduce the national income. Why? When income increase, imports increase, but when imports increase, that will reduce the national income. Why? Because now we are the consumer, they demand, or the import increase means they demand for the local goods, foreign goods. We have to import foreign goods. So that will affect the local industries, right? That reduce the employment, production, and that we analyze in the marginal analysis calculation for impact of imports, right? So that artificially increase the price, something we later on talk about tax, right? So if there is high imports, that will destroy the local production, right? Infant industry argument. Right? So if there is a discouragement for the local industry, employment level decrease, there are so many effects. Right? Finally, it reduces the national income, right? If there is high inputs. Once I decided, we pay more foreign exchange outflows, right? We are importing, right? So that will have our reserves decrease, right? and the industries collapse, no, right? Employment level decrease, no, right? So therefore, income decrease. So that's why there's negative impact. When imports increase, what happens? Why we say it's minus, because there's negative impact on national, right? But when the income level increase, there will be more demand. When our per capita income increase, there will be more demand for imports because consumption shift from local goods to foreign goods, right? We prefer foreign goods, right? But in the review of our overall economy, that will have negative, right? So the import has negative impact, export has positive impact. So we add not export, we add exports. That will increase the aggregate demand, income, right? Right? So export means we produce locally, export to the other destinations, no, other countries, no, right? So that will increase the demand and the income, right? Because we are finance, right? So those are the two things, right? So and the macroeconomic equilibrium, right? So you need to identify what is the macroeconomic equilibrium, right? So stable situation in the overall economy. When we achieve the stability in the overall economy, there should be a two things to satisfy. Aggregate demand should be equal to aggregate supply, and production should be equal to demand, right? This will be the right. Okay. So then, right. So that's all, right? So here, this is the highlighted, right? Okay, any question from that? I asked you to refer the previous things and come, right? Yeah, in the previous discussion, right? Okay, any question from your side? Further last week discussion. Now, I want to tell you, right? So we have the two assessment one today in the evening. So I will upload the assignment for you, right? So that is individual assignment. Some questions from the past, that we got, like the past system. I will give you some questions. I will mention the 6 questions. I will need to answer individual, right? So after the review, so last week, after the review, one time, right? So you were so that day we have the MCQ question also. And we had a MCQ test point. So we come down in the power of the inside. After the is later point. Let's go there, get 1 to 5. So there will be a MCQ test, right? So some questions will be given, right? On to the need to do it in a laptop, right? Computer lab, right? So within let's say 45 minutes. So there will be a 30 questions, something, right? You need to answer, right? Okay. Multiple choice questions, same thing, right? So covering lecture 1 to 5. Right? So that will cover 1 to 5, right? So we can refer the things and come, right? So that is not difficult, right? So you can, if you refer all these things, right? You can easily answer. Some questions you can answer quickly, right? Some now microeconomic analysis questions over there. Previously we talked about, right? There may be some questions, right? You need to do some calculations and find the answers, right? Like that, right? So this has to be agreed, right? So there will be no presentation, only 3 assessments, right? Because we don't have time to make presentation, right? So we have the 2 sessions we need to complete, right? From this session, today we are starting, right? Next day I will do the ISLM analysis, right? And then last day, small time will take 1 hour lecture, right? And after that you have the MCQ test and we'll finish, right? Okay, that way we plan. After the review, we have 1 time event, no? Right? I think you have vacation, no? Right? We have vacation. After that, we have 1 session, right? I will let you know through the LMS, right? So please get ready for that, right? And meantime, I will upload today and tomorrow maybe, right? I will upload the individual assignment for you. Like some questions you need to answer and submit to the LMS. Okay. And how about your group assignment? Finish the group? Right. This question is 30% last day. You need to submit it, right? How about it? Do you have any questions, queries, or something? This is democratic socialist country, right? Yeah. Hands up those who finish it, the group. Now, the one group first. Groups means you are belongs to same group. You finish your group. What is the group? Yeah. B. Group A, you know, you finish. Group B, you have B, you have C. C, there is C. Finish, not yet finish. Group C, you finish it or not? You can manage it. The D, finish. Others, I think others are in the, you don't know, they are visible groups, right? Only the visible groups here, right? Other groups, I don't know, just they are seen in the group list only, right? Okay, right? So then okay, we will move to the next topic, right? So we are going to talk about this national expenditure, right? Same thing we continue, right? Now we are going to talk about the aggregate expenditure, aggregate surplus, anything that we discussed here, right? Some of the things, right? So we are going to do that, right? And the aggregate demand, aggregate supply, right? Now we discuss about this major macro variables, right? Consumption, investment, savings, that represent the real sector as a part of the economy. And money demand, money supply, funded sector, right? Altogether, according to this explanation, so those are we identified as the major macro variables, right? So how we identify the economy according to our theoretical models that we are going to explain here, right? We identify these variables, consumption, investment, savings, money demand, and the money supply, which represent the real sector and the monetary sector in explaining the overall economy, right? So now here actually apart from that, right? So here only we identified two sectors, broad. But there are other sectors, right? So that we have time to time we discuss about the other sectors, right? What are those sectors? Only here explain the monetary sector and the real sector, right? But when we explain the overall economy, we have other sectors also, right? So that is the government sector is there, right? And also the employment sector also there. And the foreign sector, right? So those are the other sectors. Therefore, we have the now this part of this here. We have the employment sector, the government sector, the foreign sector. In our modules that we explained, basically we identified these sectors, right? Here that's the market sector that we talk about, right? But in certain cases we identify the employment, labor market and the those things, right? Separately that discuss on the government sector, foreign sector, right? So those are the other sectors apart from that we can identify. Oh yeah, our aggregate demand, right? Now according to this equilibrium, no, right? So aggregate demand or the aggregate expenditure that in turn equals to the income. No? We can explain as the consumption, investment, government expenditure, and the exports, no? Right? C plus I plus G plus X, no? Right? Right. So that forms the aggregate demand. Right. Now here we can identify the components in the aggregate demand, right? So that is the demand side factors, no, right? Which explain the aggregate demand, no, right? Or the consumption is the most important demand side factor, no, right? So that is the most important factor. Because why we say this consumption is important, right? One side from our income, we allocate a significant portion from our income for the consumption, right? So that therefore it forms the significant part of the aggregate demand as well, right? So consumption. So that is the major macro variable. We say. Why we say? Because more than 70%, 80% of your income you allocate for the consumption, right? So and if you say the consumption expenditure, that is the private consumption. So that is according to this definition given by the World Bank, right? So it is the market value of all the goods and services, including durable products purchased, right, by the household. And also we have to pay some payments for the government, no, right? So that also include those payments as well, no, right? So under the consumption, some fees we have to pay, right, by the household, right? So these things form the consumption expenditure. So that is important part, right? In as a single component in the national income, right? So aggregate demand, since it covers 80% of national income, right? So more than 70-80% of private. So from that actually, now we have the consumption, right? Private consumption and the government consumption, no? Right? So private consumption price how many around 70%, no? Right? And the government consumption also around 10% like that in average, right? So you can see the private consumption, no? So that is from the total consumption expenditure, right? So that from the significant part by the private consumption expenditure, right? So that is very important. One side, since we allocate our income, right, for the consumption mainly, right? Other important thing is, so in the Keynesian theory, like we talk about theory, right? So they are actually the consumption function play a pivotal role in explaining the national income determination through the multiplier behavior. So the multiplier basically, right, autonomous, that is called so-called autonomous expenditure multiplier. So that explains through the consumption function. So therefore, in the Keynesian theory, the consumption function play a central part, right, in explaining the national income determination. Right? So this is the basically we highlight the model that expounded by the Keynes, right, in national income determination, right? So that is the important model, right? When we use that model, right? So it actually explain this the multipliers, right? Different multipliers. These multipliers operate through the consumption function. So that's why from the theoretical side, right? So the consumption function play an important role, right? So in the economic point of view, and then you explain this national income determination also, right? Consumption function play a vital role according to the theory, right? Okay. Now so the so that's why we say the consumption function is the major part of the general theory. The general theory, who invented the general theory? John Maynard Keynes, no? Right? So that is general theory of employment, interest, and money. Right? So employment, and that in turn explain the income, right? So there actually the consumption function play an important role, right? So that actually it is an important variable, right, in economic analysis, right? Because it's part of the aggregate demand, right? Now we have the demand side factors, supply side factors. Right? Now here basically we highlight the demand side factors. So we identified the consumption as the uh, most influential demand side factor, right? And that provide tool for economic analysis. So why it's we say it's a tool? Because when we explain this national income model, right? So then we identify the consumption function as the main pivotal element, right? Since it explained the for this what you call these multipliers and so on, right? So therefore, we basically, when we analyze the consumption function, we can identify the importance of the consumption function by looking at the portion that the individual or the asset country allocate for the consumption. And that is the end result of the economy as well, right? Consumption. We identify the major economic activities, right? We identify the major economic activities in the economy, that is consumption, right? Distribution, exchange, right? Production, right? So those are the major important activities. So the consumption is the main important activity. That is the final activity of the economy, right? Once you produce, finally, we consume. Right? So that is the final activity. Okay. Right. But when you talk about this the consumption function, so there is no common argument, right? So the common opinion among the economists regarding the consumption function. So the different economics explain in different way, right? Regarding the consumption determinants. That's why there is a question, right? Okay. So that's why different theories also develop, right? So based on the consumption. We are not going to talk about those theories, right? So, but we identified mainly the Keynesian explanation regarding the consumption, right? So according to that, right, consumption mainly depends on the income, right? Okay, right. Now the first one is the actually, we just highlight this one, right? So even though there are other theories, right? Type side, welcome, and income, that is like that way, right? But when you talk about this consumption, right? So the Keynesian theory, right? So it highlighted the basically the determinants of consumption, right? In absolute income hypothesis, right? So that is the main theory, right? Developed by Keynes, right? To explain the consumption, right? Absolute income hypothesis, AIH. Right? According to the absolute income hypothesis, right? Consumption mainly depends on the income or the disposable income, right? C is a function of YD, disposable income. Consumption depends on disposable income. And according to Keynes, right? So in the 1930s, right? So we don't have the computers, right? Big analytical instruments, right? So to analyze the consumption, right? So, but Keynes explained the consumption behavior, right? And he identified the complexities of explaining the consumption behavior, right? Different people into which we analyze the consumption, their consumption, right? It's not a simple task, right? But now Keynes made the conjectures means, right? So he used his personal experience and introspection, right? Some kind of experiments, right? So when we explain the consumption function, right? So he estimated the consumption function at that time, right? So that mainly depends on the income or the disposable income. Okay. So now regarding the innovation being is the beliefs and the way of explaining the consumption. He used some concepts. One example, one thing is marginal propensity to consume, right? Average propensity to consume, right? Those things take into account, right? So those are some kind of assumptions, no? Right? So Keynes developed, right? So based on his experience and the hypothesis, right? Based on the assumptions, right? Now that is actually the Keynes consumption function mainly depends on this fundamental psychological law. So that says fundamental psychological law, right? So that's why we say it's a fundamental psychological law, right? Since he used his personal experience and some beliefs, right? And assumptions, right? He developed the consumption function. So certain things highlighted in the fundamental psychological law, right? So one thing is the relationship between the consumption and the income, right? So it assumes there is a positive relationship, right? Normally there is a positive relationship. According to the fundamental psychological law, when the income increase, aggregate income increase, consumption also increase. So there is a positive relationship, right? Normally our income level increase, consumption also increase, right? So there is a positive relationship, right? And the other one is when income increases, what happens? Are they going to consume more or less? So when income increases, people spend only a portion of their additional income, right? And save remain, right? So that means we believe that the income is distributed, part of the income consume, other part save, right? Reminder change, save, right? So that means delta Y, that is the change in income, right? Is explained by changing consumption, delta C, plus changing savings, delta S, right? So that means when income increase, part of the income consume, other part save, right? So that is the second assumption, right? According to the fundamental psychological law, right? So the delta Y equal delta C plus delta S, right? And the third one, what happens when income increases? So when income increases, savings also increase, right? So consumption increase at a decreasing rate. So people are not willing to consume more, right? When the income level increase, they are willing to save more, right? And invest, right? At higher income level, we are actually do more and more savings and the investments, right? So that is the third one, right? When income increase, consumption increase at a decreasing rate. That explains this concept we discussed late time. Average propensity to consume is greater than the marginal propensity to consume. So those are the actual gains. When he explained the consumption, he innovates something, right? Consumption function is innovation, right? And he innovates some concept, is marginal propensity to consume, marginal propensity savings, average propensity savings, average propensity consumption. Now, those are the innovative concepts. So now, theory is something developing new knowledge, right? In this consumption function, right? Spatial theory invented these concepts, right? And the multiplier function, that's also invention, right? Those are very important, right? In explaining the consumption bill, right? And national income determination, right? So this is the third one, right? In the fundamental psychological law, it says APC is higher than MPC. Average propensity to consume is higher than the marginal propensity. You look at it, right? Now, average propensity to later on we'll discuss it, right? So that is the third one, right? So that means when income increase, people are willing to save more, right? And willing to consume less. So that means when income increase, consumption increase at a decreasing rate, right? So that's why the K's consumption function, right? It's not linear. It is non-linear consumption function. C is a function of disposable income. The only, right? But we know the Keynesian consumption function, we know the here, right? It's linear. We know the Keynesian. Keynesian are the his followers, right? Now Keynes invented this idea, then after that his followers follow right? So these are called Keynesian. This is Keynesian consumption function. Keynesian consumption function, we assume we normally draw the linear line. Consumption is a linear form, right? But this consumption function is original consumption function is not linear. Because this, when income increase, consumption increase at a decreasing rate. Okay. So not linear, right? So we need to know about what is APC and MPC, no, right? So you don't know about the assume, right? You are the name, right? You don't know about APC and MPC, we will discuss. So those are the basic hypothesis, no, right? That explain according to Keynes consumption, right? Based on the fundamental scientific rule. So it's kind of identified three things, so basically. The relationship between the consumption and the income. And when income increase, how they behave, no, right? And what happened when income increase? So what happened to the consumption and the savings, right? So Y equal, so the positive relationship, right? And income is get divided between the consumption and the savings, no, right? And the APC is higher than MPC, right? Okay. So that is explained under the fundamental psychological. Right. So the now Keynesian consumption function, as we discussed, we take the linear form, right? So that is A equal A plus B by D, right? So this is the consumption. Now here we assume consumption depends on disposable income. Now that's an analytical model, simple model, two-sector model, three-sector model. We assume economy in the two sectors, household and the church. There is no government sector in this analysis, right? If there is no government sector, consumption depends on the income, no? Right? Nominal income. If there is a government sector, depends on the disposable income, because the government imposes taxes, no? Right? So we have to think about the disposable income, right? In a simple economy, simple economy means economy with household and firms only without any government, no, right? There really consumption depends on income, right? Now here we assume by D or Y, right? By D or Y, right? Consumption is A plus B by D. See the consumption, A means what is it? It's called autonomous consumption. A. So there is the intersection point of the Y, right? Consumption function, right? So this is one here, right? Intersection function. And the B means Y means disposable income. We take the Y, that is income. B means what is B? It is the slope of the consumption function, right? That is called marginal propensity to consume, right? Marginal propensity to consume increasing. So when Y income, Y increase, how much the consumption going to be changed? Is given by the marginal propensity to consume. Slope of the consumption function given by the marginal propensity to consume. So the responsiveness of consumption will change the income, what is possible income, right? Is explained by the marginal propensity to consume, right? That is delta C over delta Y, right? Marginal propensity to consume means delta C over delta Y, right? So change in income You will change in the consumption. Right. Now, normally, this marginal propensity consumed, right? It's in between 0 and 1, no? Right? Between 0 and 1, right? So it's if we allocate from our income, we consume, right? Okay, then 0 and less than 1, right? So our income is because delta Y means delta C plus delta S. Income is there less than 1. If it is in 1 means we total income we consume, right? Normally it's less than 1, right? Those part of income you save, right? Right. So the NPC, how we calculate that one? So that is the slope of the consumption part. So we measure the slope. The slope is 18. Why do we change in the consumption? That doesn't go for delta. Okay. Right. Now if you lower this curve, right? So now we take the another two axes. Here we put the consumption. Here we put the income, no? Right? So the x-axis is the income, y-axis is the consumption, right? Okay. So, right. Okay, right. Now here, so we see the consumption function starting from here, right? Because at 0 level income, there is a consumption, right? Autonomous consumption. Autonomous consumption means at 0 level income, there is a certain level of consumption, right? That depends on not only the income, right? That depends on other factors. The consumption, A plus BY. Autonomous means when income level 0, how much is the consumption? So that is given by A, right? Autonomous, right? So that means autonomous means other than the income. That explains other factors, right? Other than income. That explains other factors that determine consumption. So what are other factors that determine consumption? Yes. Maybe the price level, no, right? Consumer expectation, no, expectation. So those factors, no, right? So those, that is the autonomous. Therefore, at 0 level income, there is a certain level of consumption. This part is autonomous. Right? So A is starting from here, consumption. So upward sloping, why it's upward sloping? When income increase, consumption also increase. So there is a positive relationship as we identified with the fundamental psychological. Right? So when income level increase, consumption also increase. Right? Okay. So it's upward sloping curve. Consumption depends is possible income or income. So the DC of change in consumption divided by change in income. So that is the slope of this curve. Right? If you differentiate this function in terms of income, right, you will get the slope of this curve. That is equal to B, right? Delta C over delta C over delta Y. That is implicit. That will be equal to B, right? Okay. Right. So this is our consumption function, right? Now suppose now the consumption function is 100 plus 0.8 Y, right? That is simple economy. If we assume 2 sector, right? If it is a sector economy with the government sector, consumption 100 plus 0.8 Y. Right? Now the 0.8 is what? So then it is the NPC, right? Marginal propensity is less than 1. 80%. Right? So that is NPC. Under means autonomous consumption, right? As we know, they say consumption. So we can measure the consumption function. So we can estimate the consumption function even like in your form. Right? Okay, so then, so shall we take the break? You also sleeping, right? Ashutakaya Nidar, right? So you can have a break, right? After the break, start, right? I did that. I got two messages. And I think send me the text message.
Yes, I didn't know because we received the
Actually, I did that. One, I got message.
on Sunday. No, I did one session.
Month for your name is something.
I came okay, space. I don't know. 11:22 time.
This one.
In this one. Sorry.
This one I included. You can check in the LNS. I included that one. So I allocate randomly.
Thank you.
Need to check LNS.
Okay, I'll tell now. I thought because it has only point our team. Other group things like that.
I speak. And I did the change this.
I'll change. Thank you. I come on.
There is no online one today. Only you know it. Earlier.
Anyone got to, I have requested from them, but they didn't give the access for me. So last 2 weeks before, I have spoken to my office secretary.
Earlier you join online.
Not
You
for
didn't
the-
join.
No, I didn't do it.
Then now you have to take the things and
So I have already taken and participated.
and the group discuss.
Yes,
Also you are in the group.
yes, last week I have requested from the media. Then you have been last 3 days before you have arrived.
Ah.
Then I have joined the group. So
Can now you are joining. Tell me you are following.
yeah, okay. Basically, Saturday I have duties.
Where are you?
Reading the management. I did my decision to file a normal. So we are in the company to file a normal. So 2 weeks ago, I have only Dubai.
That's why you join online.
So how you are going to plan the exam by online or by PC?
Exam is now they are physical exam.
This will so after April.
I can't remember the dates, like that weeks you can ask. I can't remember they have given. You have then you have to follow the business economics one.
Yeah, this is
So after that you will schedule the examinations. Another I think 30 hours you have to do the business economics.
Otherwise, they will
Finishing this one, it will start the business economics. But also,
We don't really able to compare. And we don't know who is this person. The last one. Because all last 21 days.
didn't get that. Are you already up? I know that you are saying, but
No, not the person. We have already discussed and we did not get it. We don't know who is this last person.
actually, I got some request from the students. That's why I updated the.
This was in the task force last night.
Actually, they need to contact you on your work. So now finish your work. I don't know whether it's not to be part of it. Okay. Thanks. Now, his duty is to contact you. Your work.
This thing.
Is there? Is there? And you need to talk now. He must talk with you like you are.
Today's class game was we already discussed everything. We finished it. Today we realized when we were updating the links, we checked the links and we made
So when there's a problem, then there's very well first. At least he must talk with you, and then some since you are finalizing the game, first time and engaging with those activities, and in the last moment, maybe I will ask them to contact your group. You don't know?
I don't know.
This is going to be a different point.
Come today. After the break,
One student came to me, and also he doesn't know where the group, whether he's in a group or not, right? But his name also I included in the group. They are not referring to the LMS, I think. If you are not still uploaded, and you can attack it, and there are concern, you can take it, concern also. But other way, that should be happen.
within the day, we have to upload it.
Yes.
That is talking. Yes. Okay, I. Okay, I do. That is my
Okay, can we start? They are not. We can pass to. Then all these people are impact them. Can you that? A, B, C, D is the only active, I think. The groups are not active. The name is one. Leaves the you need to submit the date and leave the last name. Need to follow with them and you have to say so okay, one minute. So it's now at the moment focusing now still not finalize your kind of conclusion which you there you that you are planning to submit it today or something. Then I think if you are with basket is in the group E, he told me that it is not other members, they are not accepted that they have, they are not in the group. Right? So he must be able to be going to be able to apply. You are in group A, so we will heavy line, right? So you can give your answer, can decide it then, right? So you can finalize it, right? Yeah, practice and other members side, I have added new members to the group side, so they need to talk with their group because they are some meetings they are going to pay, right? So please talk with them and can give your concern also rise. You can find the same. You can rise in the right and that. This thing is right. Okay, right. So we'll so come to the lesson, right? So now we talk about the earlier we talk about this consumption function, right? And we identify the scope of the consumption function, right? And when we talk about the consumption function, another concept we identify the average propensity to consume, right? So that is the ratio between the consumption and the income, right? Average per unit consumption expenditure, right? Average, right? So we can express anything in average term, right? So that is the total consumption divided by the income, right? The ratio, right? Between the consumption and its maximum is the income is the average, right? So now the consumption function, right? Now we know that this, we know that in the as we is mentioned in the fundamental psychological, right? What happens when income increase? Is consumption also increase, right? APC implies, right? As income increase, now you know this when Y increase, right? APC increase, right? When Y increase, APC increase, right? Okay. So and also when income increase, right? People tend to decrease the consumption. That means consumption increase at a decreasing rate, right? So and say the fraction of income, right? So that we can see, right? So that's why we observe this APC is higher than MPC, no, right? APC is higher than HP, right? So why? No, the APC means average propensity means zero Y. MPC means delta C over delta Y. Right? So that is the B, no, as we express the consumption function. YD, right? So that is the marginal profit frequency, right? If you take this average profit frequency, C means we take the consumption function A plus BY divided by Y, right? So average profit frequency, that means A rho Y plus BY divided by Y is B, right? So that is the marginal function. That's right now. So then the marginal profit frequency, right? So APC means A rho Y plus something MPC, right? So that means APC is greater than MPC, right? APC is greater than MPC, right? Okay. When income increase, consumption increase at a decreasing rate, and people tends to save more, right? So that is the one, right? So we divide APC is a plus B minus plus. So maybe this depends on this, right? So the relationship between the APC and the MPC depends on this AOY portion, right? If it is, you can think about this AOY, it will be either positive, sometimes it may be negative, no, right? If it is negative means APC will other way around, right? If it is positive means it is higher than APC. Right? That depends on the value of this one, right? Get positive or negative. Right? So we can think about that one, right? Right? So when we come to the savings, right? Because our income, right? So the part of income consumed, other part saved, right? So that means Y equals C plus S. S means Y minus C, right? So can see simply economic, right? Y equals C plus S, no, right? How your income is you distributed. Part of income you consume, other part you save, no, right? According to the income method, no, right? According to the income method, no, right? part of your income stream, other part saving. So that saving is y minus c time. So that is the fraction of save out of total income savings, right? Y minus c time. Now saving function we can write it as, we know the consumption function, no? The opposite way, right? Savings. Minus a plus 1 minus dy, right? So here also linear function, so, right? The minus a, what is minus a? So that is the autonomous savings, right? Minus a, right? And 1 minus b is the NPS, right? NPS, right? Marginal propensity to savings, right? Consumption function, we see the B is the marginal propensity to savings, the saving function, minus A plus 1 minus BY. This is the MPS, no? Marginal propensity to savings, like MPS. You know, so that is the MPS explained by the when income increase. So the magnitude of changing savings, no, right? So the delta MPS means delta S over delta Y. So of the saving function, that is MPS, right? Responsiveness of savings due to change in the income. Because here we assume savings also depends on income, right? According to the Keynesian theory, both consumption also depends on income, savings also depends on income. Right? But some other explanation, this is the according to Keynes. Now, if you look at the classical economics ideas, consumption depends on the income, savings depends on what? There may be a different arguments, right? So the consumption, for example, if you say the classical economics. They also believe the consumption depends on income, right? Yes. Savings. Savings depends on what? Other factors. This is the classical and the Keynesian economics developed against the classicals. So, it's basically the demand side factors, right? And in this classical basically highlight the supply side is also the real factors. Is the demand side factors, right? Size analysis is supply side analysis, classical, right? So how you believe savings depends on what? Yes, anyone? Sorry? But is it income same? He believes savings also depends on income. Any other? How you think? According to the Keynesian, you know that both consumption, savings depends on the disposable income, right? It's income. In fact, it's a thing, right? How we can take this, right? What factors determine according to other economics, their explanations. So, can you be different type? Can think about it. Right. Now the saving function, right? Here also the case in here that we can, the savings, now we know we can derive the saving function, right? Because savings is y minus c. Savings, c means a plus dy or dy d, right? So by and so to minus a minus dy. So then you can write it label the a one side, this y is common, right? So that means 1 minus 3 y, right? So we can derive the same function, right? If the, because we know that income, or we distribute consumption in the savings, right? So then in the savings function, minus a, 1 minus 2. Minus 3 means autonomous savings, no, right? That's 0 level of income. Right? 1 minus 3 means marginal propensity savings. So here B is the marginal propensity to consume, 1 minus B is marginal propensity to savings. Right? Now if you derive the saving function, right? It's negative minus A, it's a negative here intersection point, right? So when the income level increase, savings also increase, right? So there is a negative savings here, no, right? And the positive savings at this point, savings equal 0, right? Because you are, so, but you are going to again analyze with the consumption function, right? The behavior of the consumption function and the income curve, right? You go that one, you can analyze the behavior of the consumption, the saving function, right? So this is the saving function, right? It's the first one. Yeah, right. And so if you look at average propensity savings, right? That is the other concept, no? Right? The ratio between the savings and the income, right? So that is given by average propensity savings. Okay. Same way, right? So we can see that APS also greater than NPS, right? Like we did earlier, no? Right? So ABC is greater than NPC, no? Right? So we can derive the based on the saving function, we can derive the average propensity savings and substitution to saving function. You can identify that NP APS is higher than NPS, right? So we can prove that one, right? Following the same thing, right? Okay. So, and if you look at these things, right? So important is the relationship for by looking at the relationship between the consumption, savings, with respect to income, right? Because your consumption, savings, income, right? Income is student, consumption, and the savings, right? So you can see the NPC plus NPS that also equals to 1, right? NPC plus NPS equals to 1, right? Because delta Y equal delta C plus delta S, right? Right. So the change in Y is explained by changing consumption due to changing income plus changing savings due to changing income, right? So that is the NPC. So changing Y is equals to 1, right? Right. That is explained by NPC plus NPS, right? So you can prove that one because NPC means P, right? NPS means 1 minus B. So that will equals to 1, right? Because our income, according to the fundamental psychological law, right? People, their income they use, right? Part of income they consume, other part they save, right? So you know that therefore you can identify the MPC and NP. Same way, APC and APS. Right. Average propensity to consume and average propensity savings also equals to 1. So how do you prove that? So if we take the delta C over delta Y plus delta S over delta Y, right? So that also equals to 1. Then prove that, right? There is a consumption function, right? So this is a delta C over delta Y, right? So that is E over Y plus S over Y, right? So that will also equals to 1, right? Average. So the equations for, right? If you simplify the equation, finally you will end up with 1, right? So you can prove that that one moves, right? So see how this equals to 1, right? Using the equations, right? So you can see how those things are equals to 1. Right. So at your question time, you can just analyze these behaviors, right? NPC plus NPS equals 1. NPC plus NPS equals to 1. Right? It's in the equations. Now, if you look at this table, right? So now, if we have given some income levels, right? And if we know the consumption function, right? Right? We can identify the consumption. Right? That's our consumption. Those, if you know the consumption, we can derive the savings. Right? Those consumption, savings is 5 minus 3. Right? 100 minus 3. We can derive the savings. Right? So then you can calculate average potential consumed, that is C over Y, right? C divided by Y. So then the marginal potential consumed, delta C over delta Y, we have to take this K, right? Divided by this K, right? It's 0.7, 7.5, 0.39, right? Average potential savings. APS. APS means savings divided by income. Right? Calculate that number then. Increase difference. Like APS, right? Now you can see APC plus APS that also equals to 1. Right? 7, 9, 2, NPC plus NPS that also equals to 1. Can the behavior when income increase, what happens? Consumption also increase, savings also increase, but normally you know that consumption increase at the increasing rate, right? So that's why if you see NPC decrease, right? Gradually decrease. NPS increase, right? Then income level increase, PC decrease, NPS increase. That means we allocate more savings, right? So consumption increase at the when income increase, consumption decrease. While savings are increase. Okay. Those things you can know. So these are the concepts that the games use, right? In order to explain the consumption behavior. It's average propensity to consume, marginal propensity to consume, right? APS and APS, right? Now, if you look at the graph, right? So normally we use the graphical analysis, right? So we can use the equations also, right? In explaining those things, right? Since we know the consumption function, the same function. Right? Now here it says V is V1. Right? What is impulsive here? What is simple C here? Hang on. Simple C, what is it? What is simple C? That is marginal propensity to conceive, no? Right? Simple C, right? And 1 minus A means LPS, no? Right? Earlier we used B, no? Right? So BY, no? Right? Now it's simple CY, right? Okay. So the consumption mainly depends on the income. And the slope is given by simple C, right? Now this is the consumption function, right? For that the income is consumption. Is the consumption. So what is this 45-degree line? What is that? 45-degree line. What is it? That is the equilibrium equation, right? So this is y equally right. Equilibrium income, right? 45-degree line. Samadaya right? Equilibrium because this 45-degree, right? So the line is getting right, right? And if you draw there is the income line, right? Starting from the origin, right? And what is the savings? So we see the savings, right? So when there is the now this is higher than the income, right? This area. So this is our income, consumption is higher than that, right? Up to this point, right? C is greater than Y. C is greater than Y means we have the negative savings. That area. Because our consumption is higher than the income. Because it is with other factors, no, right? You consume more, right? That explains the negative savings. And at this point, consumption equal income, right? At this point, at particular income level, say by 0, by 1 or something, right? At this particular income level, consumption equals income, right? So that is the intersection point, right? So savings equals 0 at this point. Savings equals 0. Then thereafter we have the income is higher than consumption, right? So therefore we have the positive savings, right? We have the positive savings in this area, right? Okay. So we can explain the relationship between the consumption and the savings behavior, right? With respect to the income change, right? Right. So those are the two curves, right? Now we identified the consumption and the savings, right? And their behavior with the income, right? Can explain in the capital terms as well. Right. So if you look at the position of the consumption curve, right? So normally the consumption we here we see we go this way, right? So positive, right? Positive with the positive slope, right? Started from weak. So but the position can be changed. How the position can be changed, right? Sometimes it goes through the origin, right? Sometimes even the consumption function look like the saving function, starting from the negative. Sometimes it starts from the positive. It depends on basically if you analyze that part, right? We know that APC, average potential to consume, right, equals A rho Y plus D, no, right? Okay. This is now APC means COY, right? The consumption function, if you substitute that finally, we can do APC equals A rho plus D, right? Then APC plus BC, right? Okay. Now suppose this if A is positive, what happens? If A is positive, autonomous consumption is positive, what happens? If A is positive, this whole part is positive, no, right? So then APC is higher than NPC. That's so we discussed earlier, no, right? This is okay, no matter, no. This will be added with the B, that will be equals to APC, that means APC higher than NPC. So that means when NPC is higher than APC is higher than NPC, consumption function like this, right? Starting from the positive y-axis. Consumption function is positive, right? Okay. So what happens if A is negative? Less than 0. Now A is negative. This one become negative. This small part become negative. Right? So then we have to be deduct A plus negative part plus B is, so this there will be this side is lower than this one, this part. So that means APC is less than NPC. And when APC is less than NPC, that means consumption function like this, right? Starting from the negative, like the saving function, right? But here, this is the consumption function. APC is less than C, right? Okay. Now, what happens if the A equals 0? Autonomous consumption is 0. Entirely the consumption depends on income. That's it, right? So, what happens? If this is 0, what happens? 0 divided by 0 means 0 divided by 5 means all part becomes 0, no? Right? So then ABC equal MPC. Right? So when A equals 0, APC equal MPC. That means consumption function goes through the whole chain. So if you draw consumption function like this, starting from the whole chain, upward trend, right? So that implies APC is equals to APC. So those are the by looking at this relationship between APC and APC with respect to this AOY component, especially the autonomous part, right? It can be positive, negative, or zero, depending on that. Some shape of the consumption or position of the consumption function change, no? Starting from positive, starting from the negative, starting from positive. Right. So same thing we can think about the saving function as well. Right. So we know that saving function, right? The average propensity to save is X over Y, right? So we can identify the average propensity saving function minus A over Y quotient plus S, right? Right. So then same thing we can identify like we discussed in the consumption function, right? If A is positive, what happens? Here, APC is less than AP S, no, right? So in that sense, consumption function, so the saving function like a consumption function. APS is less than APS, right? If A is negative, that means APS is higher than MPS, right? It's like a saving function. So this is the, sorry, this is the, if A is negative, right? APS is higher than MPS, right? So normally, normal saving function, right? Like it goes to like this. If APS is equal NPS, saving functions also like goes to those, right? APS is equal. And then by looking at this average propensity to consume savings, right? And this the marginal propensity to consume and the savings, right? So we can utilize the consumption curve, right? And the saving curve, right? And their behavior is not right. Is it clear? Any question? Right. Okay, right. So then now first our important component is the consumption, no? Right? Now aggregate demand, right? We can identify the investment. That's also very important, right? Component, right? In the aggregate demand, right? So that is the second or aggregate demand component. So why this is important? This is the private consumption. Capital formation, right? So this is important because private investment is the volatile component with the aggregate. So this is the one of the important component with the aggregate demand because aggregate demand equals C plus I, no, right? And the investment is a highly volatile component. There can be some reversal of private investment. We know that FDI, right? If there is an macroeconomic environment, favorable situation, uncertainty, private investment take place, right? That they will move the country right, for investments, right? It's a highly volatile, right? Create crisis environment due to reversal of private investment, like the private investment. If there is some reduction in private investment, that will reduce the aggregate demand sharp, like significant. That will have a negative impact on the economic shock, like a shock prices pay because of this decline in the private business. Right? So that is the highly volatile. That's important. Now here, investment includes actually there are certain components. Business investments, like residential construction, that was investment. To construct a house, something construction, that's also investment. Changing inventories, that's also part of the investment. So, but here we consider only important business investment, right? Those are the investment. Right. So, what factors determine the investment? So, there are different factors, no, right? Determine the investment. So, important factor is the interest rate, right? Investment mainly depends on the interest rate. So, that is the cost of capital, right? Interest rate, right? And the different interest rate, right? The segregate rates, right? So, the lending rates, no, right? No, right? So, the interest rate is the important concept. Investment mainly depends on interest rate, no, right? So, it's negatively related, no, right? When the interest rate increase, investment, private investment increase, right? Since the cost of capital increase, when if high interest rate, fewer projects will be viable, right? So reduce the investment demand at high interest rates. Now, what happened now? The central bank reduced the interest rate. Earlier, central bank increased the interest rate, right? Basically, the policy rates. Why? Well, you need to control inflation. Because at high interest rate, there is expansion, the dividend control. So that will reduce the investment demand. Control the liquidity expansion. Now the central bank, once it's stabilized, right? Once there's stability in the prices and the interest rate going down, right? Central bank reduce the rates also, right? Policy rates, right? In order to control the retail rates. Policy rates are the wholesale rate. Central bank decide and control. When the wholesale rate change, retail rates, that means commercial bank lending also, rate also decrease, right? Adjustment right? So that actually now there is an encouragement for the investments at a lower interest rate, right? So with the other factors, there's the environment, so that will can give the expected results, right? But not entirely depends on the interest rate, investment depending on the interest rate. So again, things are things like one important thing is the interest rate. And the other one is price, right? You also expected price, price expectation, right? So inflation, the future, how people are feel, right? What they expect in the future price, and on that, right? So if there is an inflation pressure in the economy, right? So if they believe that some price level for the future, so that will affect the investment, long-term investment. price expectation. Income also one factor, national income, GDP. If there's growth in the output, no, right, that will affect the investment. Higher growth in high income level, right? When income level increase, right, investment also encouraged. And the taxes, right, corporate taxes, right, another factor. That actually high tax is not the conducive factor, no, for the investments, no, right? There are some corporate taxes that will discourage the investment. Private investment. And the capital stock is another factor, right? So because there is a stock, right, pricing the capital tax should be the goal, right? Then we have investment, right? So changing investment in other words, yes, the main factor that determine stock. Right? So those are the factors that determine interest rate. So in our supplemental analysis, right, especially the ISL, we assume that investment really depends on the interest rate, right? So our investment function is written as I equals I0 minus I1 now. Right? So this is our investment function, right? Investment. So this is the autonomous investment, right? So this is interest rate, and it depends on the interest rate. I1 means interest elasticity of investment. Just elasticity of investment. So when interest rate change, right? So really the investment change is determined with the change in the factor of elasticity, right? How far the sensitivity between the interest rate and the investment is explained by the interest elasticity of investment, no, right? Sometimes the interest rate is not highly sensitive, even though the interest rate decrease, we can't see the investment is accelerating, no, right? So most of the research, right, they have explained that, right? Interest rate is not highly respond change in the interest investment, right? Because investment depends on number of other factors even. Right? The one factor is the interest rate, cost of capital, but if there is a political uncertainty, you know, right? If there is no macroeconomic environment, conducible environment, no, right? Sometimes external prices, internal prices, that affect the business investments, no, right? So if there is uncertainty in the environment, no, people not invest, no, right? Now what is happening? People are not investing, no, right? No constructions, no projects, no investments, no. The stimulus sector is collapsed, no, right? No. There is no encouragement because of the uncertainty. We don't know how the things happen in the future, no, right? So people wait and see. That is called real option theory, right? According to the real option theory, so if there is uncertainty, right? Risk factor is high, no? People wait and see, no, right? They are not going to invest in big projects, no, right? That is happening. So that actually, even though the interest rate change, right? So how much the investment is really changed, that is explained by the interest elasticity. That depends on number of other factors. So that explains the sensitivity between the relationship or sensitivity between the interest rate and the investment. Interest elasticity. I1 can be low or I1 can be high under such circumstances, right? If there is a low sensitivity, no, I1 is low. If there is high sensitivity, small change in the interest rate, significantly change the investment, right? That means high interest elastic, no, right? If there is inelastic, there is a low interest rate, there is a low sensitivity, like that, you know, right? So that we need to analyze, right? So that will not we look at later, right? Those are the things. Now this is the name function of the investment, right? I1, I1, right? I1 the thing I1, I1, I1. What is the this is the item, right? Interest elasticity of okay, right. So then other factor, money demand and the money supply. Those are the multiple factors that we have. So according to this money demand, we believe that depends on why people demand money. It depends on three factors, no? Right? One is the transaction demand, no? Right? Other one is called precautionary. Last one is the speculative, no? Right? Right. So why people demand money? Why people like to hold money in their pockets, no? Right? So that is the demand for money. People demand money for different motives. No? Transaction for day-to-day transactions, no? Right? So you want to travel, you want to spend in money, right? For the goods and other entertainments, no? Right? For day-to-day expenses, you need to keep certain amount of money in your pockets, no? Right? So that is money demand under transaction mode. So that depends on income, no? Right? So the money demand, the transaction mode, right? Money demand under transaction, then it depends on income. It's positive related, no? Right? When income increase, when your income increase, you keep more money in your pocket, you can spend, no? You can spend for leisure, no? Entertainment, right? So many films, right? So you can do other shoppings and so on, right? You can go to this MC and eat something, no, right? Other places, no, right? So when your income increase, you keep more money under the transaction code. That's not right. You are spending also high, right? So then it depends on income. And the precautionary mode, what is precautionary? What is precautionary? Unexpected events, no, right? Sometimes you may, when you are coming, you suddenly ill, no, right? You need medical checkup or medical treatments, right? Sometimes you meet with an accident, right? Sometimes your car broken, no? So need to be undergo some maintenance or something. Your eyes, your repairs, no, car repairs, something, no? Unexpected events. We need to spend money in unexpected event for medical bills, no, like hospital bills, no, like so, no, like you don't know what happened, right? The currency, right? So that is speculation, precaution. Money demand under precaution. That depends on, that also depends on income, no? Your income level increase, what happened? You are not going to the government hospital, you go to the private hospital, no, under such circumstances, right? So when your income increase, you sit at private. If your income is low, you go to the government hospital. But these days it's not. There is a fear, no, go to the government hospital, no treatments, no medicine, no, right? Sometimes loan treatments, no, right? Right? So many things, no, right? So that is another thing, right? So money demand under precautionary, that also depends on income, right? That also positive, right? When income increase, so we keep more money for your unexpected events, right? Just use. Right? And the other one, that is speculative motive, that is called portfolio motive, no, right? Money demand under speculative, that depends on the income and the interest rate as well. Right? Mainly the interest rate is also significant there, right? So when there's a negative relationship, right? When the interest rate change, money demand and the speculative decrease, right? Because portfolio motive, right? With the change in the prices, no, right? You are going to earn something, no? That is earning purpose, no, right? Profit motive, right? You keep money for profit motive. In earlier cases, transaction and speculative, no? There is no profit, right? You spend something, right? And like that, yeah. The business purpose, no, right? To maintain the portfolio, shares and treasury bills, treasury bonds with respect to change in the prices, no, interest rate and so on, right? You invest here and there, no, right? In order to earn something, right? Right? So you look at the share market developments, no, right? When there is a rise in the interest rate, right? What happens? In the price of bonds, oil prices This is the face value, no? Interest rate. When the interest rate increase, bond prices decrease, no? Right? And the price of bonds, no? Right? Shares, no? Right? Because you invest in share market because of the two reasons, no? One is you expect the dividends, other one is capital gain, no? Right? But dividends you annually get, but 10%, 20% maybe maximum, no? Right? But you invest in share market in order to get the capital gain, no? Right? Adara හෙට දෙන්න, right? No. Are you doing the share market activities? Are you investing share market? You have to do, right? Or when the prices decrease, you need to purchase some, right? And when the prices increase slightly, you can sell it and get the capital gains, no? Right? සමහරව අදාරගෙන හෙට විකුණනවා, right? Since there's a price changes, no? Right? So last time there's a decline in the price, no? Right? Share market, no? Right? So people willing to purchase some of the by looking at the performance of these performance of the firms, no, analyzing those things, no, right? So you can do it, right? And you can get some money, you can earn, right? So like that is speculative motive, right? So people demand money for different purposes, right? Now under the Keynesian analysis, this speculative motive is the unique contribution made by the Keynes to the demand function. Earlier, we identified this money demand and transaction proportion. It was classical economics even talk about the money demand. Basically, they think money acts as a medium of exchange. Why people demand money for day-to-day expenses only, right? But Keynes simplified by developing the money demand function, it's speculative model, right? So that is the unique contribution made by the Keynes for the money demand function, right? By looking at all these things, now we are going to talk about the money demand function. C naught plus C1 y minus C2 y. So this is our money demand function. Now, like we discussed investment function, right? So in our analysis, right? Especially in the ISL, right? We take the money demand function this way. C naught plus C1y minus C2y, because money demand mainly depends on the income and the interest rate, no? Right? According to the motives, no? Right? Yeah, right. Now the positive related to the income, and the income increase, whatever money demand under the transaction and precautionary motive increase, no? Right? When income increase, money demand also increase. Why? Under the transaction and precautionary motives. When interest rate increase, money demand decrease, so, right? Under the speculative motive. So that explains the behavior of the money demand, right? With respect to the income and the interest rate, right? So we are going to look at that, right? So that is the total money demand, right? So why people demand, why people hold money spendable for it, right? And the other side, the money supply, no, right? That is another important variable, money supply, but that is a policy variable, right? Why we say it's a policy variable? Money supply. So it's determined by the central bank according to the monetary policy. Money supply is the total stock of money in the economy that form the liquidity, right? That form the liquidity. That is also important variable, right? Because money supply measure, right, based on the monetary aggregation, right? N1, N2, N2B, N4, right? Raw money, forward money, consolidated forward money, total money, right? Based on the monetary survey, right? Because based on the monetary aggregates, we can assess the liquidity, right? So the market, right? Raw money concept, that they use the currency and the demand deposit, right? M1 means currency and the demand deposit held by the public, right? Commercial bank. Okay. So that is the money supply, no? M1, currency and the demand deposit. Demand deposit are current account balance, right? Right. Current account balance. Right. M2 means M1 plus time and saving deposit, no? Held by the public in commercial bank. Right. M2B that we take the M2 plus this time and saving deposit of the foreign currency bank, which is 50%, right? Right. We come to the M4, M2B plus some other banks, right? Time saving deposit, the license commercial banks, license commercial banks, and investment banks, no? All these things we take. Right. Right. It's more than us, right? So that measures the total money stock between them. So central banks, market policy basically control the supply, right? As part of it. So policy variable, right? Okay. So according to this money demand and the money supply, if you look at that is the money market, financial market. For money demand, normally we don't downward profit, right? So this is the money supply. Money supply is vertical, right? So policy variable, right? It's determined by the central bank, right? We take it. So what determines money demand and the money supply? That determines the interest rate. This is the real money balance, right? When more big, right? So that is the real money balance, right? So money demand mainly depends on the income of the day, right? So what happened? So at a particular level income, right? This is at a particular level. This is the money demand curve, right? This is money supply curve. So then determine the interest rate of the money market. What happens if there is a rise in the income? If there is a rise in the income level increase from policy to volume 1, this curve shift to the right, right? Right. If there is a rise in the income, and it demand increase, right? Under the transaction. That increase the interest rate as well. Because when the money demand increase and the prevailing interest rate, then create the excess money demand, right? When there is excess money demand and prevailing interest rate, right? There will be upward pressure on interest rate to rise, right? So as a result, interest rate increase from R0 to R. So if when the income level increase, if it is purely determined by the market process or without central bank intervention, interest rate also adjusted, right? So money market comes to equilibrium. Here, earlier equilibrium point is this. Later on, equilibrium change, right? Market is equilibrium, right? And think about based on the money demand function. Earlier, when the income increase, money demand increase. That's why money demand goes to the right, right? So that create instability in the market and the prevailing interest rate, right? Because the reason there's no change in the interest rate, right? So there is excess money. That is instability in the market. So therefore, there should be in order to make the equilibrium, in order to be stable money demand, so money market after the equilibrium, what happens? That when the income level increase, there's excess money demand, right? So in order to reduce the excess money demand, there should be a rise in the interest rate. When the interest rate rise, money demand increase under the speculative mode. How much interest rate increase until this excess money demand comes to zero? So that means when the interest rate increase at this point, market comes to the equilibrium, market clears. So that's why you see interest rate move from R0 to R1 like that. Right? We can explain the movement. Right? Right. So there are so many things, right? So, we will talk about this, right? Right. So, is it, am I going fast? Yes. Are you sleeping? So these are the important things, right? If you know the really things, right, you can incorporate those things into the analysis, right? So these are some of the things actually we will talk about more, right? When we the latter part, right? So I think we have only just overview we have because it is the principles of economics, right? We are not going to look at all these aspects in a deeper way, right? So sometimes there may be since we are having the overview, right? Some of the things we cannot explain in detail, right? So the concepts behind these changes, right? If I try to explain all these things, we don't have time to explain these things, right? So that's why I skip all these things, right? Now, I think that is the one, right? So basically, we identify the real sector and the monetary sector is this, no, right? We talk about money demand and the money supply. How the equilibrium, right, is determined, right? So you can think about all these things. If there is a change in the money supply, what happened? So central bank use expansion in monetary policy. Central bank increase the money stock in the economy, right? Liquidity, that shift the money supply curve to the right, right? So there will be a decline in the interest rate. Therefore, we assume money demand does not change. Only one factor we take at a time, right? So you can think about that. If there is expansion in monetary policy, so money supply goes shift to the right. If there is a contraction in monetary policy, money supply goes shift to the left. No? Right. So this is the market base. No? We are not talking about the central bank policy rates and so on, because central bank artificially controls the rates different, no? Right, from this. So this is purely the market operate, no? Right, according to the demand and supply, right? So the interest rate also adjusted accordingly, right? So that is the market clear rate, because all the time market is clear, right? At this point, so you can say why this point, we assume initially the market is in equilibrium, but when the interest rate increase, it is in the another equilibrium point, you can see, right? By analyzing this. Because transaction precaution and it will be more to earlier money demand inflow, then it decreases, right? Market come with equilibrium. Market is clear, like that. Okay. Now we are going to talk about this national income, right? So we need to look at this aggregate demand and the components, right? So that is our intention, right? So now what you feel, right? Regarding this, right? So, can you understand what we are talking? If you refer the things, right, now what we are talking, the flow, right? Now we talk about the major macro variables, consumption, investment, savings, money demand, money supply, okay? So consumption, investment behavior, we talk about separately, right? And investment also we identified, investment function, right? So what determines the investment and so on. And the money demand and the money supply. So what determines the money demand? Those are the motives. Money supply is the policy factor. It determined by the central bank, based on the central bank objectives, price stability, basically, right? So that is the behind factors, right? Now we talk about the macroeconomic equilibrium, right? Right, early, right? So that is the stable situation in the overall economy. When aggregate demand equal aggregate supply, and when injections equal withdrawal, right? At the equilibrium. Now this is the first condition, right? Aggregate demand equal aggregate supply, right? So aggregate supply Y equals, that is the net national product, no, right? And that in turn equals to the aggregate demand, no, right? Right. So we can see aggregate demand in a closed economy environment with no government. So that is the simple economy, no, right? Government එක නැත්නම්, right? Only we see the household and the firms, no, right? Right. So that means household, that is the main factor is the consumption. Firm, main factor is the investment, right? So we have the aggregate demand components, consumption, investment, right? C plus I, right? Right. So aggregate demand, aggregate supply, aggregate expenditure, that equals to the consumption plus investment, right? Okay. So now this is consumption. Why we say it's Y? It's mainly depends on the income, no, right? Interest rate, why we say it's R? It depends on the interest rate, no, right? Investment depends on the interest. Now this is the expenditure approach, no, right? Because your expenditure, how you allocate part of the expenditure, you allocate for the consumption, no, right? Other part for the investment expenditure, no, right? That is the expenditure approach, no, right? Earlier we mentioned the income approach. No? According to the income approach, your income, how you allocate, part of the income you consume, other part you save, no, right? Here, part of the income you consume, other part invest according to the expenditure, right? And here, now initially we assume price level is constant. Right? But there are models that we explain under the flexible prices as well, right? Later on, we relax the price change, right? The aggregate demand, aggregate supply, right? We can see how these prices affect the aggregate demand and the aggregate supply, right? But we are not supposed to discuss all these things, right? Now, what here we mentioned the price level is constant, no? Right? We are not talking about the prices here, right? Okay. Right. Now, equilibrium in the Keynesian model, right, that we are going to talk about. According to the income method, Y equals C plus S plus T with the government sector, no, right? If there is a government sector, tax and the subsidies came into operation, no? Scale, no, right? So now in a three sector model, right? So income is how you explain the income. Part of the income you consume, other part you save, and part of income you pay as a taxes, no, based on your income, no, right? So that means consumption. So income is Y equals C plus S plus T, no, right? According to the income method. According to the expenditure method, part of income you consume, other part invest, and another part government also spend, no, right? That means C plus I plus T. Those are the expenditure, no, right? According to the expenditure. But you know that this at the equilibrium point, Y equal T, no, right? Aggregate demand equal, aggregate expenditure equal income, right? Y equal E at the equilibrium. Therefore, we can relate these two. C plus S plus C equals C plus I plus T. Okay, right? So then you can cancel out this common C. Then you can see S plus T equal I plus T. No? This is the closed economy environment with the government, no, right? Government also there because taxes, government expenditure there, no, right? But you can see what is the C plus S plus T? What is C plus I plus T? So to simplify that one, S plus T equal I plus T. No? S plus T, those are the withdrawals, no, right? I plus T, those are the injections, no, right? It has a positive impact, no, right? So S plus T equal I plus, that is the equilibrium, right? Based on the injections and withdrawal. So now if you, that is a closed economy, no, right? With the government. If we have an open economy environment, what happens? We have to incorporate export and the imports also into this model, right? So then our picture we can explain, right? So imports we denoted as M, right? Right. That means we are going to import goods from the rest of the countries and export means so it's a part of the aggregate demand, no? Aggregate expenditure that we made on the exported goods, no, right? That we produce locally, right? So here, at that one now GDP means we can say C plus I plus D or GNP or something, right? C plus I plus D X minus M. We add the net export to our model. But we know that these exports and the imports, export are the injections, no? Import are the withdrawal from our model. So therefore, in an open economy environment, we can change this one, right? So according to this also, we can change this income method, C plus S plus D plus, what do you call N? Expenditure method, C plus I plus D plus X, right? Simplifying that one, you can say S plus D plus N equal I plus D plus X, right? Like that, injection something. No problem. Okay, right? So this is the case, right? So according to this expenditure, right? Consumption, investment, government expenditure, and net export, right? Net exports, right? So this is the income, right? Part of the economic consumption, other part is save, other part is the expenses, right? So we take the in the full-fledged open economic model injections equals to okay. So these are injections, these are positive impact of on national income. These have the negative impact on national. Now we can write this one as this way also anything. We take the I into this side, right? S we take, right? Plus G minus D. G minus D. The common expenditure is D, taxes are D. G minus D, you can take it separate, right? And X minus D. So we can write this I equal S plus B minus B plus X minus. What is it? This is the investment, right? Investment in a simple economy, I equal S, right? Then we take. Can you remember that? Simple economy, we take income, we take the C plus S. Then we take plus I, right? Y equal V. So the C plus X equals C plus I. Then I equal S. In simple economy, I equal S. Injections equals to A. Right? So now here the government step. Whatever. So we have to take the open economy. In open economy, we have to take the government interventions, what's together. So here investment equal S plus P minus T. This is the domestic savings. So this is the public savings. Public savings, government savings, P minus T. P is the tax revenue minus government expenditure. So that is the government savings, right? And this is the foreign savings. Okay. Export minus imports, that is the foreign savings. So you also broadly explain investment equals savings, right? So savings here comprise in domestic savings, government savings, and foreign savings, right? So I equal S final, right? We can write it, right? So this is the government savings, right? A minus B. That is the other words, public savings. There is a surplus in the current account balance in the budget, that is the government savings, so, right? Right. Okay. Right. Now we know that we talk about inflation cycle withdrawal, right? Now we come to the equilibrium, right? So how we explain the equilibrium graphically, and we can do the equation also, right? Taking the simple model, right? First we talk about simple, right? Only the simple we are not going to talk about other things, right? In the simple economy, so national income equilibrium is Y equal E, right? Two conditions, Y equal E, okay, I equal S, okay? Injections equal E. Simple economy, I means injection, savings withdrawal, no, right? And Y equal E, Y equals C plus I, right? Okay. C plus I means simple economy, equilibrium, and you can see it as Y equals C plus I. So how we derive this one? Can you know this how to derive a simple equation? You know or not? How we derive this one? We derive that. You don't know? We have like okay. So how we derive now C plus I. So our consumption function is A plus dy. Okay, we can write that now. Our now write it C naught plus C11, right? So you can use different notations, right? But earlier we used A plus dy, no, right? Now I write now here use space as C naught, right? C naught is the autonomous consumption, no, right? C1 is the marginal propensity consumption, P, no, right? V1, C1, right? Okay. Okay. Apply this, right? Our investment, autonomous item, right? We have investment, right? Now, what is the equilibrium? Y equals C plus I. Okay. So our equilibrium is in the simple economy. We have the household and the firms, no? Consumption and the investment. So this is the expenditure. Okay. So Y we can write C means what? C naught plus V1 Y, which is simple economy. No need to write YB, no, right? Since there is no government, right? There is a government, you know, think about taxes and subsidies all over the right. Investment is I, right? That is autonomous expenditure. So I have, right? It does not depends on the income. No? Interest rate, investment depends on the interest rate, not on the income, no? Right? Right. Pass. I made a mistake. And remember, I wrote it consumption and Keynesian consumption depends on income and the investment depends on interest rate. Okay. So then that is the Keynesian, right? And the classical theory consumption depends on what? Savings, right? On the investment savings. Here savings depends on first rate. Sorry, both are depends on income, right? So I made a mistake. Now I get the idea, right? So, and you remember we mentioned I asked you to think about, right? So this is the gain thing. Consumption and the savings, both consumption depends on income, savings depends on interest rate according to the case. Now here the classical consumption depends on income, savings also depends on income, right? Okay. All right, right. Now here, now you can simplify this equation. How do you simplify it? Here, this one. Finally, we derive that. So this is the equilibrium equation, no? Right? Okay. Equilibrium equation. Equilibrium national income. Why is the equilibrium national income? You can explain it. Right? Now here, how to simplify this? We take y to this side. We are going to derive the equilibrium income. C1 y minus positive income minus then C naught and I naught. And C I naught. Right? So all these things are autonomous expenditure, right? Autonomous consumption, autonomous investments. Right side variables are autonomous expenditure. Right? C1 is the marginal velocity consumer. Y is common. 1 minus C1. Okay. Y is common. 1 minus C1 equals C0 plus I. Those are the autonomous expenditure. We denote them as AE. Right. Here actually we use equivalent notation, right? Autonomous expenditure. Those are for autonomous expenditure. Right. So we can write equilibrium in terms y equals 1 minus C, we can take into other side, 1 minus C1 into autonomous exponent. That means E0 plus I0. Right? So this is the equilibrium equation, right? That is the equilibrium equation, right? Y equal 1 over 1 minus C1 plus autonomous exponent into autonomous exponent. Right. Now here you see 1 more 1 minus C1. What is that? That is called multiplier, no? Right? That is called autonomous expenditure. Expenditure multiplier. Autonomous expenditure multiplier. With respect to change in autonomous expenditure, no, right? C and I, no, right? So there is a multiplier effect on national income. Right? When autonomous expenditure change certain percentage, you this multiplier, there will be more effect on income. Right? So that is the multiplier. Right? So that is called autonomous expenditure multiplier. K, right? K equal 1 over 1 minus C1. Right? K is the multiplier autonomous expenditure multiplier. Right? 1 over 1 minus C1. So what does it determine? Here we have 1, again 1 minus C1. So mainly depend on the marginal propensity to consume, no, right? This multiplier 1 minus C means MPS. You can write this one as again K equal 1 over 1 minus MPS 1 minus MPC or 1 over MPS, no, right? So that is the multiplier. Because 1 minus C is MPS, no, right? So we can write multiply K equal 1 over MPS, right? So when this, so that mainly depends on the C1, no? Or MPS, no, right? Multiply. Right? So C1 make a value of the way. When C1 is rising, what happens? This becomes lower, no? Multiply increase, no, right? When C1 rising, what happens? Multiply also increase, no, right? So there's a positive relationship, no, right? When C1 increase, this whole part decrease. When this part is decreased, this 1 over 1 minus C1 increase. So that means multiply. When MPS increase, what happens? PS increase. That is 1 more, they can't do anything, right? Multiplier decrease, no, right? So two different types. So then you can find the autonomous expenditure multiplier. This is called autonomous expenditure multiplier. It explains the responsiveness of income due to change in the autonomous expenditure. Responsiveness of income due to change in the autonomous expenditure. Here the autonomous expenditure, autonomous consumption, autonomous investment, right? So that is the equilibrium, macroeconomic equilibrium. In a simple economy, we assume here only the two sectors, household and the firms. But you must remember there